1. Introduction to investor mistakes. 1.1 Understanding the importance of avoiding mistakes. Investing in the financial markets can be a rewarding and profitable endeavor. However, it is not without its risks. One of the key factors that can determine the success or failure of an investor is their ability to avoid common mistakes. Understanding the importance of avoiding these mistakes is crucial for anyone looking to achieve long-term financial success. Mistakes in investing can have a significant impact on an individual's financial well-being. They can result in substantial losses, missed opportunities, and even financial ruin. Therefore, it is essential to recognize the potential pitfalls and take proactive steps to avoid them. 1.1.1 The cost of mistakes. Investor mistakes can be costly, both in terms of financial loss and missed opportunities. Making poor investment decisions can lead to significant financial setbacks, eroding the value of one's portfolio and potentially jeopardizing long-term financial goals. For example, buying stocks based on rumors or hot tips without conducting proper research can result in investing in companies with weak fundamentals or unsustainable business models. This can lead to substantial losses when the market corrects itself or when the company fails to deliver on its promises. Similarly, timing the market incorrectly can have severe consequences. Trying to predict short-term market movements and making frequent trades based on these predictions can result in transaction costs, taxes, and missed opportunities for long-term growth. 1.1.2 Emotional impact on investment decisions. One of the primary reasons investors make mistakes is the influence of emotions on their decision-making process. Emotions such as fear, greed, and overconfidence can cloud judgment and lead to irrational investment choices. Fear can cause investors to panic and sell their investments during market downturns, locking in losses instead of riding out the temporary fluctuations. On the other hand, greed can drive investors to chase after high-risk, high-reward opportunities without considering the potential downsides. Overconfidence is another common emotional trap that investors fall into. It can lead to excessive trading, overestimating one's abilities, and taking on unnecessary risks. Overconfidence can also prevent investors from seeking professional advice or considering alternative viewpoints, leading to poor decision-making. 1.1.3 Learning from others' mistakes. Understanding the importance of avoiding mistakes also involves learning from the experiences of others. By studying the mistakes made by successful and unsuccessful investors alike, individuals can gain valuable insights into what to avoid and how to navigate the complex world of investing. For example, the history of financial markets is filled with stories of investors who lost fortunes due to poor decision-making. By examining these cases, investors can identify common patterns and behaviors that lead to failure. This knowledge can help them avoid making similar mistakes and improve their chances of success. Additionally, learning from successful investors can provide valuable lessons on how to approach investing with discipline, patience, and a long-term perspective. By studying their strategies and mindset, individuals can gain insights into how to avoid common pitfalls and achieve their financial goals. 1.1.4 The benefits of avoiding mistakes. Avoiding mistakes in investing can have numerous benefits. Firstly, it can help protect and preserve one's capital. By making informed and rational investment decisions, individuals can minimize the risk of significant losses and ensure the long-term growth of their portfolio. Secondly, avoiding mistakes can lead to better investment returns. By conducting thorough research, understanding the fundamentals of the companies or assets being invested in, and avoiding impulsive decisions, investors can increase their chances of selecting high-quality investments that generate attractive returns over time. Furthermore, avoiding mistakes can help investors build confidence in their investment approach. By developing a disciplined mindset and sticking to a well-thought-out investment plan, individuals can reduce the impact of emotions on their decision-making process and make more rational choices. Lastly, avoiding mistakes can save investors valuable time and effort. By focusing on sound investment strategies and avoiding unnecessary risks, individuals can avoid the need to constantly monitor and adjust their portfolio. This allows them to spend more time on other important aspects of their lives while still achieving their financial goals. In conclusion, understanding the importance of avoiding mistakes is crucial for investors looking to achieve long-term financial success. Mistakes can be costly, both in terms of financial loss and missed opportunities. By recognizing the potential pitfalls, learning from the experiences of others, and developing a disciplined investment approach, individuals can increase their chances of making sound investment decisions and achieving their financial goals. 1.2 Common misconceptions about investing. Investing can be a complex and intimidating endeavor, especially for those who are new to the world of finance. Many people hold common misconceptions about investing that can lead to costly mistakes and missed opportunities. In this section, we will explore some of these misconceptions and shed light on the truth behind them. 1.2.1 Investing is only for the wealthy. One of the most prevalent misconceptions about investing is that it is only for the wealthy. Many people believe that they need a large sum of money to start investing and that it is out of reach for those with limited financial resources. However, this is far from the truth. Investing is not limited to the wealthy, it is accessible to anyone with even a small amount of money to spare. In fact, starting early and investing regularly, even with small amounts, can have a significant impact on long-term wealth accumulation. The key is to focus on building a diversified portfolio and taking advantage of the power of compounding. 1.2.2 Investing is like gambling. Another common misconception is that investing is akin to gambling. Some people believe that investing in the stock market is nothing more than a game of chance, where luck plays a significant role in determining success or failure. While there is an element of risk involved in investing, it is far from being a game of chance. Unlike gambling, investing is based on careful analysis, research, and understanding of the underlying fundamentals of the investments. Successful investors make informed decisions based on thorough research and analysis, rather than relying on luck or speculation. By diversifying their portfolios and adopting a long-term investment approach, investors can mitigate risks and increase their chances of achieving their financial goals. 1.2.3 Timing the market is the key to success. Many investors believe that timing the market is the key to success. They try to predict the highs and lows of the market, buying when prices are low and selling when prices are high. However, market timing is a challenging and often futile endeavor. The reality is that no one can consistently predict the short-term movements of the market with precision. Trying to time the market often leads to missed opportunities and increased transaction costs. Instead, successful investors focus on long-term trends and invest in quality assets that have the potential to grow over time. By adopting a buy-and-hold strategy, investors can benefit from the power of compounding and ride out the short-term market fluctuations. 1.2.4 Investing is a get-rich-quick scheme. Another misconception is that investing is a get-rich-quick scheme. Some people believe that they can make quick and substantial profits by investing in the latest hot stocks or following the advice of self-proclaimed investment gurus. However, this is far from the reality of investing. Investing is a long-term endeavor that requires patience, discipline, and a well-thought-out investment plan. It is not a shortcut to instant wealth. Successful investors understand that wealth accumulation takes time and that it requires a consistent and disciplined approach. They focus on building a diversified portfolio, managing risks, and staying committed to their investment strategy over the long term. 1.2.5 Investing is only for experts. Many individuals believe that investing is a complex and specialized field that is best left to the experts. They feel overwhelmed by the jargon, technical analysis, and financial concepts associated with investing. As a result, they shy away from investing altogether or rely solely on the advice of financial professionals. While it is true that investing requires some level of knowledge and understanding, it is not limited to experts. With the abundance of educational resources available today, anyone can learn the basics of investing and make informed decisions. By taking the time to educate themselves and seek guidance from reputable sources, individuals can gain the confidence and knowledge needed to navigate the investment landscape. 1.2.6 Investing is a one-size-fits-all approach. Another misconception is that investing follows a one-size-fits-all approach. Some people believe that there is a single investment strategy or formula that guarantees success for everyone. However, this is far from the truth. Investing is a highly individualized process that depends on various factors, including risk tolerance, financial goals, time horizon, and personal circumstances. What works for one person may not work for another. Successful investors understand the importance of tailoring their investment approach to their specific needs and circumstances. They work with financial professionals to develop a customized investment plan that aligns with their goals and risk tolerance. In conclusion, it is crucial to dispel common misconceptions about investing to make informed decisions and avoid costly mistakes. Investing is not limited to the wealthy, nor is it a game of chance or a get-rich-quick scheme. It requires careful analysis, a long-term perspective, and a disciplined approach. By understanding the truth behind these misconceptions, investors can set themselves up for success and achieve their financial goals. 1.3 The impact of emotions on investment decisions. Emotions play a significant role in our everyday lives, and investing is no exception. The decisions we make when it comes to our investments are often influenced by our emotions, which can have a profound impact on our overall investment success. Understanding the impact of emotions on investment decisions is crucial for investors who want to avoid common pitfalls and make informed choices. 1.3.1 The role of emotions in investing. Investing is inherently an emotional endeavor. When we invest our hard-earned money, we are putting our financial security and future at stake. This can trigger a range of emotions, including fear, greed, excitement, and anxiety. These emotions can cloud our judgment and lead to irrational decision-making. Fear is one of the most powerful emotions that can influence investment decisions. During times of market volatility or economic uncertainty, fear can drive investors to panic and sell their investments at the wrong time. This fear of losing money can prevent investors from taking advantage of potential long-term gains. On the other hand, greed can also be a driving force behind investment decisions. When markets are performing well, investors may become overconfident and chase after high returns without considering the underlying risks. This can lead to impulsive and ill-informed investment choices. 1.3.2 The impact of emotional biases. Emotional biases are cognitive shortcuts that our brains use to simplify decision-making. While these biases can be helpful in certain situations, they can also lead to poor investment choices. Understanding and recognizing these biases is essential for investors who want to avoid falling into common emotional traps. One common emotional bias is the herd mentality. This bias occurs when investors follow the crowd and make investment decisions based on the actions of others, rather than conducting their own research. This can lead to a lack of independent thinking and a tendency to buy or sell investments based on the fear of missing out or the fear of losing out. Another emotional bias is the anchoring bias. This bias occurs when investors fixate on a specific piece of information, such as the purchase price of a stock, and use it as a reference point for future decisions. This can prevent investors from objectively evaluating new information and adjusting their investment strategy accordingly. 1.3.3 Emotional decision-making and market timing. Emotional decision-making often goes hand in hand with the desire to time the market. Many investors believe they can predict short-term market movements based on their emotions or gut feelings. However, research has consistently shown that market timing is extremely difficult, if not impossible, to consistently achieve. Emotional decision-making can lead investors to buy or sell investments based on short-term market fluctuations, rather than focusing on long-term investment goals. This can result in missed opportunities for growth and increased transaction costs. 1.3.4 Strategies to overcome emotional biases. While it is impossible to completely eliminate emotions from investment decisions, there are strategies that investors can employ to mitigate the impact of emotional biases. One effective strategy is to develop a well-defined investment plan. By setting clear investment goals and establishing a disciplined approach, investors can reduce the influence of emotions on their decision-making process. Following a predetermined plan can help investors stay focused on their long-term objectives and avoid impulsive actions driven by emotions. Another strategy is to practice mindfulness and self-awareness. By being aware of our emotions and how they can influence our investment decisions, we can take a step back and evaluate the situation objectively. This can help us make more rational and informed choices, rather than being driven solely by our emotions. Additionally, seeking advice from a trusted financial advisor can provide an objective perspective and help investors navigate through emotional challenges. A professional advisor can offer guidance based on their expertise and experience, helping investors make more informed decisions and avoid common emotional pitfalls. Conclusion. Emotions have a significant impact on investment decisions. Fear, greed, and other emotional biases can cloud our judgment and lead to poor investment choices. Recognizing and understanding the influence of emotions is crucial for investors who want to avoid common pitfalls and make rational decisions. By developing a disciplined investment approach, practicing self-awareness, and seeking professional advice when needed, investors can overcome emotional biases and increase their chances of long-term investment success. 1.4 Developing a mindset for successful investing. Developing a mindset for successful investing is crucial for achieving long-term financial goals and avoiding common investor mistakes. While many people focus solely on the technical aspects of investing, such as analyzing financial statements and market trends, it is equally important to cultivate the right mindset to navigate the complexities of the market. In this section, we will explore the key elements of a successful investor mindset and provide practical tips for developing it. 1.4.1 Understanding the psychology of investing. Investing is not just about numbers and charts, it is also deeply influenced by human psychology. Understanding the psychological factors that drive investment decisions is essential for developing a successful mindset. One of the most significant psychological factors is the fear of missing out, FOMO. Many investors make impulsive decisions based on the fear that they will miss out on a lucrative opportunity. This can lead to poor investment choices and ultimately result in financial losses. Another psychological factor is the tendency to follow the crowd. Investors often feel more comfortable making decisions that align with the majority. However, this herd mentality can lead to buying at the peak of a market bubble or selling during a market downturn. Successful investors understand the importance of independent thinking and are not swayed by the opinions of others. 1.4.2 Cultivating patience and discipline. Patience and discipline are two essential qualities for successful investing. The market can be unpredictable, and it is crucial to have the patience to wait for the right opportunities. Impulsive decisions driven by emotions can lead to poor investment outcomes. By cultivating patience, investors can avoid making hasty decisions based on short-term market fluctuations. Discipline is equally important in maintaining a successful investment strategy. It involves sticking to a well-thought-out plan and not deviating from it based on short-term market movements. Successful investors understand that market volatility is a natural part of investing and do not let it deter them from their long-term goals. They have the discipline to stay the course and not be swayed by short-term market noise. 1.4.3 Embracing a long-term perspective. Successful investors have a long-term perspective when it comes to their investments. They understand that investing is not a get-rich-quick scheme but a journey that requires time and patience. By focusing on long-term goals, investors can avoid the temptation to make impulsive decisions based on short-term market movements. A long-term perspective also allows investors to take advantage of the power of compounding. By reinvesting dividends and allowing their investments to grow over time, investors can benefit from the exponential growth of their wealth. This long-term mindset helps investors stay focused on their goals and avoid being swayed by short-term market fluctuations. 1.4.4 Managing risk and embracing diversification. Successful investors understand the importance of managing risk and embracing diversification. They recognize that investing in a single stock or asset class can expose them to unnecessary risk. By diversifying their portfolio across different asset classes, sectors, and geographic regions, investors can reduce the impact of any single investment on their overall portfolio. Managing risk also involves setting realistic expectations and being prepared for potential losses. Successful investors understand that not every investment will be a winner and that losses are a natural part of the investing process. By managing risk effectively, investors can protect their capital and minimize the impact of any potential losses. 1.4.5 Continuous Learning and Adaptation. The investment landscape is constantly evolving, and successful investors understand the importance of continuous learning and adaptation. They stay informed about market trends, economic indicators, and industry developments. By staying up to date with the latest information, investors can make informed decisions and adjust their investment strategies accordingly. Continuous learning also involves reflecting on past mistakes and learning from them. Successful investors are not afraid to admit when they have made a wrong decision and use it as an opportunity to grow and improve. By analyzing past mistakes, investors can identify patterns and develop strategies to avoid repeating them in the future. 1.4.6 Seeking professional advice. While developing a successful investor mindset is crucial, it is also important to recognize when professional advice is needed. Seeking guidance from a qualified financial advisor or investment professional can provide valuable insights and help investors make informed decisions. A professional can offer objective advice, help develop a personalized investment plan, and provide ongoing support and guidance. However, it is essential to choose the right financial advisor who aligns with your investment goals and values. Conduct thorough research, ask for recommendations, and interview potential advisors to ensure they have the necessary expertise and experience to meet your needs. In conclusion, developing a mindset for successful investing is a critical component of achieving long-term financial goals. By understanding the psychology of investing, cultivating patience and discipline, embracing a long-term perspective, managing risk, continuously learning and adapting, and seeking professional advice when needed, investors can avoid common mistakes and increase their chances of investment success. 2. Lack of research and due diligence. 2.1 The importance of research in investment decision-making. Research is a fundamental aspect of successful investing. It involves gathering and analyzing information to make informed investment decisions. Without proper research, investors are essentially gambling with their money, relying on luck rather than knowledge and analysis. In this section, we will explore the importance of research in investment decision-making and how it can help investors avoid costly mistakes. 2.1.1 Understanding the value of research. Research provides investors with the necessary information to evaluate investment opportunities, assess risks, and make informed decisions. It helps investors understand the underlying factors that can impact the performance of an investment, such as market trends, industry dynamics, and company fundamentals. By conducting thorough research, investors can gain insights into the potential risks and rewards associated with an investment, enabling them to make more informed choices. 2.1.2 Identifying investment opportunities. One of the primary benefits of research is the ability to identify investment opportunities. By conducting thorough research, investors can uncover undervalued assets, emerging industries, and companies with strong growth potential. Research allows investors to evaluate the financial health, competitive position, and growth prospects of companies, helping them identify investments that align with their investment goals and risk tolerance. 2.1.3 Assessing risks and rewards. Research plays a crucial role in assessing the risks and rewards associated with an investment. It helps investors evaluate the financial stability of a company, analyze its historical performance, and assess its future growth prospects. By conducting in-depth research, investors can identify potential risks, such as industry downturns, regulatory changes, or competitive threats, and make informed decisions based on their risk appetite. 2.1.4 Understanding market trends and dynamics. Research allows investors to stay informed about market trends and dynamics. By analyzing market data, economic indicators, and industry reports, investors can gain insights into the broader market conditions and identify potential investment opportunities. Research helps investors understand the factors that drive market movements, such as interest rates, consumer behavior, and technological advancements, enabling them to make more informed investment decisions. 2.1.5 Evaluating company fundamentals. Research helps investors evaluate the fundamentals of a company, including its financial statements, management team, competitive advantage, and growth prospects. By analyzing financial statements, such as balance sheets, income statements, and cash flow statements, investors can assess a company's profitability, liquidity, and solvency. Research also involves evaluating the quality of a company's management team, its competitive position in the market, and its ability to generate sustainable growth. 2.1.6 Mitigating investment risks. Research is essential for mitigating investment risks. By conducting thorough research, investors can identify potential red flags, such as excessive debt, poor corporate governance, or declining market share. Research helps investors make informed decisions based on objective analysis rather than relying on rumors or emotions. It allows investors to assess the potential downside risks of an investment and take appropriate measures to mitigate those risks. 2.1.7 Making informed investment decisions. Ultimately, research empowers investors to make informed investment decisions. It provides them with the necessary information and analysis to evaluate investment opportunities, assess risks, and determine the potential rewards. By conducting thorough research, investors can make decisions based on facts and analysis rather than relying on speculation or hearsay. Research helps investors align their investment decisions with their financial goals, risk tolerance, and investment time horizon. 2.1.8 Avoiding costly mistakes. One of the primary benefits of research is its ability to help investors avoid costly mistakes. By conducting thorough research, investors can identify potential pitfalls, such as overvalued assets, unsustainable business models, or misleading financial statements. Research allows investors to make more informed decisions, reducing the likelihood of making impulsive or emotional investment choices that can lead to significant financial losses. 2.1.9 Developing a research process. To effectively incorporate research into their investment decision-making process, investors should develop a systematic approach. This involves setting clear research objectives, identifying reliable sources of information, and establishing a framework for analyzing and evaluating investment opportunities. By following a structured research process, investors can ensure that their decisions are based on thorough analysis and reduce the likelihood of making hasty or ill-informed investment choices. 2.1.10 Utilizing technology and tools. In today's digital age, investors have access to a wide range of technology and tools that can enhance their research capabilities. Online platforms, financial news websites, and investment research services provide investors with real-time market data, company information, and analytical tools. By leveraging these resources, investors can streamline their research process, access timely information, and make more informed investment decisions. In conclusion, research is a critical component of successful investing. It enables investors to identify investment opportunities, assess risks, and make informed decisions. By conducting thorough research, investors can avoid costly mistakes, mitigate risks, and align their investment decisions with their financial goals. Developing a systematic research process and utilizing technology and tools can further enhance the effectiveness of research and investment decision-making. 2.2 Common research mistakes to avoid. Research is a crucial aspect of making informed investment decisions. It involves gathering and analyzing relevant information about potential investments to assess their viability and potential returns. However, even experienced investors can make mistakes when conducting research, which can lead to poor investment choices and financial losses. In this section, we will explore some common research mistakes that investors should avoid to improve their investment outcomes. 2.2.1 Relying on biased or incomplete information. One of the most common research mistakes is relying on biased or incomplete information. It is essential to gather information from multiple sources to gain a comprehensive understanding of an investment opportunity. Relying solely on one source, such as a friend's recommendation or a single news article, can lead to a skewed perspective and inaccurate assessment. Investors should strive to gather information from reputable sources, such as financial news outlets, company reports, and industry publications, to ensure a well-rounded analysis. 2.2.2 Neglecting to analyze financial statements and ratios. Financial statements and ratios provide valuable insights into a company's financial health and performance. However, many investors make the mistake of neglecting to analyze these essential documents. By understanding financial statements, such as the balance sheet, income statement, and cash flow statement, investors can assess a company's profitability, liquidity, and solvency. Additionally, analyzing financial ratios, such as the price-to-earnings ratio, return on equity, and debt-to-equity ratio, can help investors compare a company's performance to its industry peers and make more informed investment decisions. 2.2.3 Failing to consider the competitive landscape. Investors often focus solely on the potential of a specific investment without considering the competitive landscape. Failing to assess the competitive environment can lead to investing in companies that may struggle to maintain their market position or face intense competition. It is crucial to research and understand the competitive dynamics within an industry, including the market share of key players, barriers to entry, and potential disruptors. By considering the competitive landscape, investors can make more informed decisions about the long-term viability and growth potential of an investment. 2.2.4 Overlooking the importance of industry analysis. Investors sometimes overlook the significance of conducting thorough industry analysis. Understanding the trends, challenges, and opportunities within a specific industry can provide valuable insights into the potential success of an investment. By analyzing industry dynamics, such as market size, growth rate, regulatory environment, and technological advancements, investors can identify industries that are poised for growth and select investments accordingly. Ignoring industry analysis can lead to investing in declining or stagnant sectors, resulting in subpar returns. 2.2.5 Failing to assess management quality and track record. The quality of a company's management team plays a crucial role in its success. However, many investors make the mistake of neglecting to assess management quality and track record when conducting research. It is essential to evaluate the experience, expertise, and integrity of the management team before making an investment decision. Investors should consider factors such as the CEO's leadership style, the the management team's ability to execute strategies, and their track record of delivering consistent results. By assessing management quality, investors can gain confidence in the company's ability to navigate challenges and drive long-term value. 2.2.6 Ignoring potential risks and red flags. Investors often make the mistake of overlooking potential risks and red flags when conducting research. It is crucial to assess both the upside potential and the downside risks of an investment. By identifying and analyzing potential risks, such as regulatory changes, competitive threats, and financial vulnerabilities, investors can make more informed decisions and implement risk mitigation strategies. Ignoring red flags can lead to investing in companies with significant underlying issues, which can result in substantial financial losses. 2.2.7 Failing to update research and stay informed. Research is an ongoing process, and investors should continuously update their knowledge and stay informed about their investments. Failing to update research and stay informed can lead to outdated information and missed opportunities. Investors should regularly review company reports, industry news, and economic trends to ensure they have the most up-to-date information. By staying informed, investors can adapt their investment strategies to changing market conditions and make timely decisions. 2.2.8 Overlooking the importance of qualitative analysis. While quantitative analysis, such as financial statements and ratios, is essential, investors should not overlook the importance of qualitative analysis. Qualitative factors, such as a company's brand reputation, customer loyalty, and corporate culture, can significantly impact its long-term success. Investors should consider qualitative factors alongside quantitative data to gain a holistic understanding of an investment opportunity. By incorporating qualitative analysis, investors can make more well-rounded and informed investment decisions. In conclusion, conducting thorough research is vital for successful investing. By avoiding common research mistakes such as relying on biased information, neglecting financial statements, overlooking industry analysis, and failing to assess management quality, investors can improve their decision-making process. Additionally, staying informed, considering both quantitative and qualitative factors, and regularly updating research are essential practices for making informed investment decisions. By avoiding these common research mistakes, investors can increase their chances of achieving their investment goals and avoiding unnecessary financial losses. 2.3 Understanding financial statements and ratios. Financial statements and ratios play a crucial role in the investment decision-making process. They provide valuable insights into the financial health and performance of a company, allowing investors to make informed choices. Understanding how to analyze and interpret financial statements and ratios is essential for avoiding common investor mistakes and making sound investment decisions. 2.3.1 Importance of financial statements. Financial statements are comprehensive reports that provide a snapshot of a company's financial position, performance, and cash flows. They consist of three main components: the balance sheet, income statement, and cash flow statement. Each statement provides different information that investors can use to evaluate a company's financial health. The balance sheet provides a snapshot of a company's assets, liabilities, and shareholders' equity at a specific point in time. It helps investors assess a company's liquidity, solvency, and overall financial stability. By analyzing the balance sheet, investors can determine if a company has enough assets to cover its liabilities and if it has a strong financial foundation. The income statement, also known as the profit and loss statement, shows a company's revenues, expenses, and net income over a specific period. It helps investors evaluate a company's profitability and growth potential. By analyzing the income statement, investors can assess a company's ability to generate profits and its overall financial performance. The cash flow statement provides information about a company's cash inflows and outflows during a specific period. It helps investors understand how a company generates and uses its cash. By analyzing the cash flow statement, investors can assess a company's ability to generate cash, its liquidity position, and its ability to meet its financial obligations. 2.3.2 Key financial ratios. Financial ratios are mathematical calculations that provide insights into a company's financial performance and help investors compare companies within the same industry. By analyzing financial ratios, investors can assess a company's profitability, liquidity, solvency, and efficiency. Here are some key financial ratios that investors should understand. Profitability ratios. Profitability ratios measure a company's ability to generate profits relative to its sales, assets, and equity. Examples of profitability ratios include gross profit margin, net profit margin, return on assets (ROA), and return on equity (ROE). These ratios help investors evaluate a company's profitability and its ability to generate returns for its shareholders. Liquidity ratios. Liquidity ratios measure a company's ability to meet its short-term obligations. They assess a company's ability to convert its assets into cash to cover its current liabilities. Examples of liquidity ratios include the current ratio and the quick ratio. These ratios help investors assess a company's short-term financial health and its ability to meet its financial obligations. Solvency ratios. Solvency ratios measure a company's ability to meet its long-term obligations. They assess a company's financial leverage and its ability to repay its long-term debt. Examples of solvency ratios include the debt-to-equity ratio and the interest coverage ratio. These ratios help investors evaluate a company's long-term financial stability and its ability to manage its debt. Efficiency ratios. Efficiency ratios measure a company's ability to utilize its assets and resources effectively. They assess a company's operational efficiency and its ability to generate sales and profits. Examples of efficiency ratios include the inventory turnover ratio, the accounts receivable turnover ratio, and the asset turnover ratio. These ratios help investors evaluate a company's operational efficiency and its ability to generate returns from its assets. 2.3.3 Analyzing financial statements and ratios. Analyzing financial statements and ratios requires a systematic approach and a deep understanding of the company's industry and business model. Here are some steps to effectively analyze financial statements and ratios. Review the financial statements. Start by reviewing the company's balance sheet, income statement, and cash flow statement. Look for trends, patterns, and anomalies that may indicate the company's financial health and performance. Calculate key financial ratios. Calculate the relevant financial ratios based on the information provided in the financial statements. Compare these ratios with industry benchmarks and historical data to gain insights into the company's financial performance. Interpret the ratios. Interpret the financial ratios in the context of the company's industry, business model, and competitive landscape. Identify strengths, weaknesses, and areas of concern that may impact the company's future prospects. Compare with peers. Compare the company's financial ratios with those of its competitors and industry peers. This comparison can provide valuable insights into the company's relative performance and competitive position. Consider qualitative factors. While financial statements and ratios provide quantitative data, it is essential to consider qualitative factors as well. Factors such as industry trends, management quality, competitive advantages, and market conditions can significantly impact a company's financial performance. Seek expert advice. If you are unsure about analyzing financial statements and ratios, consider seeking advice from a financial professional or an investment advisor. They can provide valuable insights and help you make informed investment decisions. By understanding financial statements and ratios, investors can gain a deeper understanding of a company's financial health and performance. This knowledge allows them to make informed investment decisions and avoid common mistakes that can lead to financial losses. Remember, thorough research and due diligence are essential for successful investing. 2.4 Conducting due diligence on investment opportunities. When it comes to investing, conducting due diligence is a crucial step in the decision-making process. Due diligence refers to the thorough research and analysis that investors undertake to evaluate the potential risks and rewards of an investment opportunity. It involves gathering and reviewing relevant information, assessing the financial health of the company or asset, and considering various factors that may impact the investment's performance. 2.4.1 Importance of due diligence. Conducting due diligence is essential because it helps investors make informed decisions and minimize the risks associated with their investments. By thoroughly examining an investment opportunity, investors can gain a deeper understanding of its potential and identify any red flags or warning signs that may indicate a risky or unsuitable investment. One of the primary reasons why due diligence is crucial is that it allows investors to assess the financial health and stability of the company or asset they are considering investing in. By reviewing financial statements, such as balance sheets, income statements, and cash flow statements, investors can evaluate the company's profitability, liquidity, and overall financial performance. This analysis helps investors determine whether the investment opportunity aligns with their investment goals and risk tolerance. Furthermore, conducting due diligence enables investors to evaluate the market conditions and industry trends that may impact the investment's performance. By researching the industry landscape, analyzing market trends, and considering competitive forces, investors can assess the potential growth prospects and sustainability of the investment opportunity. This analysis helps investors make more accurate projections and forecasts about the investment's future performance. 2.4.2 Steps in conducting due diligence. Conducting due diligence involves a systematic approach that includes several key steps. While the specific process may vary depending on the type of investment and the investor's preferences, the following steps provide a general framework for conducting due diligence. Step 1. Define investment objectives and criteria. Before diving into the due diligence process, it is essential to clearly define your investment objectives and criteria. This involves determining your risk tolerance, return expectations, investment time horizon, and any specific preferences or constraints you may have. By establishing these parameters upfront, you can focus your due diligence efforts on opportunities that align with your investment goals. Step 2. Gather information. The next step is to gather relevant information about the investment opportunity. This includes reviewing the company's financial statements, annual reports, and any other available financial data. It is also important to research the industry, market trends, and competitive landscape to gain a broader understanding of the investment's potential. Additionally, it can be beneficial to gather information from external sources such as industry reports, news articles, and expert opinions. This external research can provide valuable insights and perspectives that may not be readily available from the company's own disclosures. Step 3. Analyze financial performance. Once you have gathered the necessary information, it is crucial to analyze the financial performance of the investment opportunity. This involves reviewing the company's financial statements, assessing key financial ratios, and comparing the company's performance to industry benchmarks. By conducting a thorough financial analysis, you can evaluate the company's profitability, liquidity, solvency, and overall financial health. Step 4. Assess management and governance. Another important aspect of due diligence is assessing the management team and corporate governance practices of the company. This involves evaluating the experience and track record of key executives, understanding their strategic vision and decision-making processes, and assessing the company's governance structure and policies. A strong and capable management team is often a critical factor in the success of an investment. Step 5. Evaluate risks and potential returns. During the due diligence process, it is crucial to identify and evaluate the risks associated with the investment opportunity. This includes assessing both internal risks, such as operational and financial risks, as well as external risks, such as regulatory and market risks. By understanding the potential risks, investors can make more informed decisions and implement risk mitigation strategies if necessary. Simultaneously, it is important to evaluate the potential returns of the investment. This involves estimating the investment's growth prospects, analyzing the competitive landscape, and considering any unique factors that may contribute to the investment's success. By assessing the potential returns, investors can determine whether the investment opportunity offers an attractive risk-reward profile. Step 6. Seek professional advice. In some cases, conducting due diligence may require specialized knowledge or expertise. If you are unsure about certain aspects of the investment opportunity or if you lack the necessary skills to conduct a thorough analysis, it is advisable to seek professional advice. Consulting with financial advisors, industry experts, or investment professionals can provide valuable insights and help you make more informed investment decisions. 2.4.3 Documentation and record keeping. Throughout the due diligence process, it is essential to maintain detailed documentation and records of your findings. This includes keeping copies of financial statements, research reports, and any other relevant documents. By documenting your due diligence process, you can refer back to your analysis and findings in the future, track the progress of your investments, and learn from past experiences. Additionally, maintaining proper documentation is crucial for compliance purposes, especially if you are investing in regulated markets or working with institutional investors. It demonstrates that you have conducted thorough due diligence and can provide evidence of your decision-making process if required. 2.4.4 Conclusion. Conducting due diligence is a critical step in the investment process that helps investors make informed decisions and mitigate risks. By following a systematic approach and thoroughly evaluating investment opportunities, investors can increase their chances of success and avoid costly mistakes. Remember, due diligence is an ongoing process, and it is important to regularly review and update your analysis as market conditions and investment landscapes evolve. 3. Overconfidence and overtrading. 3.1 The dangers of overconfidence in investing. Overconfidence is a common psychological bias that can have detrimental effects on investment decisions. It occurs when investors have an inflated belief in their abilities, leading them to overestimate their knowledge, skills, and the accuracy of their predictions. While confidence is generally seen as a positive trait, overconfidence can be a dangerous pitfall in the world of investing. The illusion of control. One of the main dangers of overconfidence is the illusion of control. Overconfident investors tend to believe that they have more control over the outcomes of their investments than they actually do. They may feel that they can accurately predict market movements, time their trades perfectly, or beat the market consistently. This illusion can lead to excessive risk-taking and a disregard for proper risk management strategies. Overestimating abilities. Overconfident investors often overestimate their abilities and knowledge in the financial markets. They may believe that they possess unique insights or have access to information that others do not. This can lead to a false sense of security and a failure to conduct thorough research and due diligence. Overconfidence can blind investors to potential risks and cause them to make hasty investment decisions based on incomplete or biased information. Excessive trading. Another consequence of overconfidence is excessive trading. Overconfident investors may believe that they can outperform the market by frequently buying and selling securities. They may engage in speculative trading strategies, such as day trading or chasing hot tips, in an attempt to capitalize on short-term market movements. However, research has consistently shown that frequent trading tends to result in lower returns and higher transaction costs. Confirmation bias. Overconfidence often goes hand in hand with confirmation bias, which is the tendency to seek out information that confirms pre-existing beliefs and ignore or dismiss information that contradicts them. Overconfident investors may selectively interpret information in a way that supports their optimistic outlook, while disregarding warning signs or negative indicators. This can lead to a distorted perception of reality and a failure to objectively assess investment opportunities. Emotional decision-making. Overconfidence can also lead to emotional decision-making. When investors are overly confident in their abilities, they may become emotionally attached to their investment decisions and unwilling to admit when they are wrong. This can result in holding on to losing positions for too long, known as falling in love with a stock, or refusing to cut losses when necessary. Emotional decision-making can cloud judgment and prevent investors from making rational choices based on objective analysis. Overcoming overconfidence. Recognizing and overcoming overconfidence is crucial for successful investing. Here are some strategies to help investors avoid the dangers of overconfidence. 1. Stay humble and open-minded. Acknowledge that the financial markets are complex and unpredictable. Adopt a humble attitude and be open to different perspectives and opinions. Recognize that no one can consistently predict market movements with certainty. 2. Conduct thorough research. Take the time to conduct thorough research and due diligence before making investment decisions. Avoid relying solely on your own intuition or limited information. Seek out diverse sources of information and consider different viewpoints to gain a more comprehensive understanding of the investment landscape. 3. Diversify your portfolio. Diversification is a key risk management strategy that can help mitigate the impact of individual investment failures. By spreading your investments across different asset classes, sectors, and geographic regions, you can reduce the risk of being overly exposed to a single investment or market. 4. Set realistic expectations. Set realistic expectations for your investments and avoid chasing unrealistic returns. Understand that investing involves both ups and downs, and that losses are a natural part of the process. By setting realistic goals, you can avoid the temptation to take excessive risks in pursuit of unattainable gains. 5. Seek professional advice. Consider seeking professional advice from a qualified financial advisor or investment manager. They can provide objective guidance, help you navigate the complexities of the market, and keep your emotions in check. A professional can also provide an outside perspective and challenge your assumptions, helping you avoid the pitfalls of overconfidence. 6. Maintain discipline and patience. Develop a disciplined investment approach and stick to your investment plan. Avoid making impulsive decisions based on short-term market fluctuations or emotional reactions. Maintain a long-term perspective and resist the urge to constantly tinker with your portfolio. 7. Learn from mistakes. Embrace a growth mindset and view mistakes as learning opportunities. Analyze your past investment decisions, identify any patterns of overconfidence, and make adjustments to your approach. Continual learning and adaptation are essential for improving your investment practices over time. By understanding the dangers of overconfidence and implementing strategies to mitigate its impact, investors can increase their chances of making sound investment decisions and achieving long-term financial success. 3.2 Recognizing overtrading and its consequences. Overtrading is a common mistake that many investors make, often without even realizing it. It refers to the excessive buying and selling of securities within a short period of time, driven by the belief that frequent trading will lead to higher profits. However, overtrading can have serious consequences and can significantly impact an investor's overall returns. 3.2.1 Understanding overtrading. Overtrading is often fueled by emotions such as greed, fear, and impatience. Investors who engage in overtrading tend to be driven by the desire for quick profits and the fear of missing out on potential gains. They may constantly monitor the market, looking for opportunities to buy and sell securities, and may make impulsive decisions without thoroughly analyzing the underlying fundamentals of the investments. 3.2.2 The consequences of overtrading. Increased transaction costs. Overtrading leads to a higher number of transactions, resulting in increased brokerage fees, commissions, and other transaction costs. These costs can eat into an investor's profits and reduce overall returns. Reduced investment returns. Frequent buying and selling of securities can lead to short-term gains, but it often results in lower long-term investment returns. Overtrading can prevent investors from holding on to their investments for a sufficient period of time to benefit from the potential growth and compounding effects. Emotional stress. Overtrading can be emotionally draining for investors. Constantly monitoring the market, making quick decisions, and dealing with the volatility of short-term price movements can lead to increased stress and anxiety. This emotional rollercoaster can cloud judgment and lead to further impulsive trading decisions. Lack of focus on long-term goals. Overtrading often distracts investors from their long-term investment goals. Instead of focusing on building a well-diversified portfolio and sticking to a disciplined investment strategy, overtraders are more concerned with short-term market movements and trying to time the market. Increased risk. Overtrading can expose investors to higher levels of risk. Frequent buying and selling of securities can lead to a lack of diversification and increased exposure to market volatility. It also increases the likelihood of making poor investment decisions based on short-term market fluctuations rather than long-term fundamentals. Lower tax efficiency. Overtrading can have negative tax implications. Short-term capital gains are typically taxed at higher rates than long-term capital gains. By constantly buying and selling securities, investors may generate more short-term gains, resulting in higher tax liabilities. 3.2.3 Signs of overtrading. Recognizing the signs of overtrading is crucial in order to avoid its negative consequences. Here are some common signs that indicate an investor may be overtrading. Frequent buying and selling. If an investor is constantly buying and selling securities, particularly within a short period of time, it may be a sign of overtrading. This behavior suggests that the investor is not giving their investments enough time to grow and is instead focused on short-term gains. High turnover ratio. The turnover ratio measures the frequency with which an investor buys and sells securities within a given period. A high turnover ratio indicates excessive trading activity and may be an indication of overtrading. Chasing short-term market trends. Investors who constantly chase short-term market trends and make impulsive investment decisions based on recent price movements are more likely to be overtrading. This behavior shows a lack of focus on long-term investment goals and a tendency to be swayed by short-term market fluctuations. Neglecting fundamental analysis. Overtraders often neglect thorough fundamental analysis of the investments they make. Instead, they rely on short-term price movements and market trends to guide their trading decisions. This lack of research and due diligence can lead to poor investment choices. 3.2.4 Avoiding overtrading. To avoid the negative consequences of overtrading, investors should consider the following strategies. Develop a long-term investment plan. Investors should develop a well-defined investment plan that aligns with their long-term financial goals. This plan should include a diversified portfolio and a disciplined approach to investing. Stick to a buy and hold strategy. Instead of constantly buying and selling securities, investors should adopt a buy and hold strategy. This approach involves holding onto investments for a longer period of time, allowing them to benefit from potential growth and compounding effects. Set clear investment criteria. Investors should establish clear investment criteria based on thorough research and analysis. This will help them make informed investment decisions and avoid impulsive trading based on short-term market fluctuations. Practice patience and discipline. Patience and discipline are key to successful investing. Investors should resist the urge to make frequent trades and instead focus on their long-term investment goals. This requires staying committed to the investment plan and avoiding emotional decision-making. Regularly review and rebalance the portfolio. While it is important to avoid overtrading, investors should still regularly review and rebalance their investment portfolio. This ensures that the portfolio remains aligned with their long-term goals and risk tolerance. By recognizing the signs of overtrading and implementing strategies to avoid it, investors can improve their investment outcomes and increase their chances of long-term success. It is important to remember that investing is a marathon, not a sprint, and that patience and discipline are key to achieving financial goals. 3.3 Strategies to avoid overconfidence and overtrading. Overconfidence and overtrading are two common mistakes that many investors make, often leading to poor investment decisions and financial losses. In this section, we will explore strategies that can help investors avoid these pitfalls and develop a more disciplined approach to investing. 3.3.1 Recognizing overconfidence. The first step in avoiding overconfidence is to recognize when it is present in your investment decision-making process. Overconfidence can manifest in various ways, such as believing that you have superior knowledge or skills compared to other investors, underestimating the risks involved in an investment, or being overly optimistic about the potential returns. To overcome overconfidence, it is important to remain humble and acknowledge that investing is inherently uncertain and unpredictable. Recognize that no one can consistently predict the future direction of the market or individual stocks. By accepting this reality, you can avoid making impulsive and irrational investment decisions based on unfounded confidence. 3.3.2 Conducting thorough research. One effective strategy to avoid overconfidence and overtrading is to conduct thorough research before making any investment decisions. This involves analyzing the fundamentals of the companies or assets you are considering investing in, understanding their financial health, competitive position, and growth prospects. By conducting thorough research, you can make more informed investment decisions based on facts and data rather than relying on gut feelings or market rumors. This approach helps to reduce the likelihood of making impulsive trades driven by overconfidence. 3.3.3 Setting realistic expectations. Another strategy to avoid overconfidence is to set realistic expectations for your investments. It is important to understand that investing is a long-term endeavor and that achieving consistent, high returns is not guaranteed. By setting realistic expectations, you can avoid chasing unrealistic targets and making impulsive investment decisions based on overconfidence. To set realistic expectations, consider factors such as historical market performance, the risk associated with different asset classes, and your own risk tolerance. By aligning your expectations with these factors, you can develop a more rational and disciplined approach to investing. 3.3.4 Diversifying your portfolio. Diversification is a key strategy to mitigate the risks associated with overconfidence and overtrading. By spreading your investments across different asset classes, sectors, and geographic regions, you can reduce the impact of any single investment on your overall portfolio. Diversification helps to protect your portfolio from the negative consequences of overconfidence. If you are overly confident about a particular investment and it performs poorly, the impact on your overall portfolio will be minimized if you have diversified your investments. 3.3.5 Implementing a long-term investment strategy. Overconfidence often leads to short-term thinking and frequent trading, which can be detrimental to long-term investment success. One effective strategy to avoid overtrading is to implement a long-term investment strategy. A long-term investment strategy involves identifying your investment goals and time horizon and developing a plan to achieve them. This plan should include a diversified portfolio of investments that align with your risk tolerance and long-term objectives. By focusing on the long term, you can avoid being swayed by short-term market fluctuations and reduce the temptation to make impulsive trades based on overconfidence. 3.3.6 Seeking independent advice. Seeking independent advice from professionals can also help investors avoid overconfidence and overtrading. Financial advisors or investment professionals can provide objective insights and guidance based on their expertise and experience. They can help you develop a disciplined investment approach, set realistic expectations, and avoid making impulsive investment decisions driven by overconfidence. When seeking professional advice, it is important to choose advisors who are reputable, qualified, and have a fiduciary duty to act in your best interest. Collaborating with professionals can provide you with a valuable external perspective and help you avoid the pitfalls of overconfidence and overtrading. 3.3.7 Practicing self-discipline. Developing self-discipline is crucial in avoiding overconfidence and overtrading. It requires the ability to control your emotions, stick to your investment plan, and resist the temptation to make impulsive trades based on overconfidence. One way to practice self-discipline is to establish clear investment rules and guidelines for yourself. These rules can include criteria for buying and selling investments, such as specific price targets or fundamental indicators. By following these rules consistently, you can avoid making impulsive decisions driven by overconfidence. Additionally, regularly reviewing and evaluating your investment performance can help you stay disciplined. By analyzing your past investment decisions and their outcomes, you can identify any patterns of overconfidence or overtrading and make adjustments to your approach as needed. 3.3.8 Learning from past mistakes. Learning from past mistakes is an essential strategy to avoid repeating the same errors driven by overconfidence and overtrading. Take the time to reflect on your past investment decisions and analyze the outcomes. Identify any instances where overconfidence or overtrading may have influenced your decisions and led to poor results. By analyzing your mistakes, you can gain valuable insights and learn from them. Use these lessons to refine your investment approach, develop better risk management strategies, and avoid falling into the trap of overconfidence and overtrading in the future. In conclusion, avoiding overconfidence and overtrading is crucial for successful investing. By recognizing overconfidence, conducting thorough research, setting realistic expectations, diversifying your portfolio, implementing a long-term investment strategy, seeking independent advice, practicing self-discipline, and learning from past mistakes, you can develop a more disciplined and rational approach to investing. These strategies will help you avoid the pitfalls of overconfidence and overtrading and increase your chances of achieving long-term investment success. 3.4 Building a disciplined investment approach. Building a disciplined investment approach is crucial for long-term success in the market. It requires a combination of self-control, patience, and adherence to a well-defined investment strategy. In this section, we will explore the key principles and practices that can help investors develop a disciplined approach to their investments. 3.4.1 Setting clear investment objectives. Before embarking on any investment journey, it is essential to establish clear investment objectives. These objectives serve as a roadmap for your investment decisions and provide a framework for measuring success. Whether your goal is to grow your wealth, generate income, or preserve capital, having a clear objective will help you stay focused and disciplined. When setting your investment objectives, it is important to consider your risk tolerance, time horizon, and financial goals. By aligning your investments with your objectives, you can avoid impulsive decisions driven by short-term market fluctuations and stay committed to your long-term plan. 3.4.2 Creating an investment plan. Once you have established your investment objectives, the next step is to create a well-defined investment plan. A solid investment plan outlines your asset allocation strategy, diversification approach, and risk management techniques. It serves as a blueprint for your investment decisions and helps you stay disciplined during market volatility. When creating your investment plan, consider diversifying your portfolio across different asset classes, such as stocks, bonds, and real estate. Diversification helps reduce the impact of any single investment on your overall portfolio and can help mitigate risk. Additionally, establish a systematic approach to rebalancing your portfolio periodically to maintain your desired asset allocation. 3.4.3 Following a long-term perspective. One of the key principles of a disciplined investment approach is maintaining a long-term perspective. Successful investors understand that short-term market fluctuations are inevitable and often noise in the grand scheme of things. By focusing on long-term trends and fundamentals, investors can avoid making impulsive decisions based on short-term market movements. To maintain a long-term perspective, it is important to avoid reacting to every market fluctuation and instead focus on the underlying value of your investments. This requires discipline and the ability to tune out the noise of daily market news. By staying committed to your long-term investment plan, you can avoid the pitfalls of emotional decision-making and achieve better investment outcomes. 3.4.4 Implementing a systematic investment approach. A disciplined investment approach often involves implementing a systematic investment strategy. Systematic investing involves regularly investing a fixed amount of money into the market, regardless of its current state. This approach takes advantage of dollar-cost averaging, where you buy more shares when prices are low and fewer shares when prices are high. By implementing a systematic investment approach, you remove the temptation to time the market and instead focus on consistent, disciplined investing. This strategy helps smooth out the impact of market volatility and can lead to better long-term returns. It also helps instill discipline by removing the emotional aspect of investment decisions. 3.4.5 Regularly reviewing and reassessing your investments. Building a disciplined investment approach requires regular review and reassessment of your investments. It is important to periodically evaluate the performance of your portfolio and make adjustments as needed. This includes reviewing your asset allocation, analyzing the performance of individual investments, and considering any changes in your financial situation or investment objectives. Regularly reviewing your investments allows you to identify any potential issues or opportunities and make informed decisions. It helps ensure that your investments remain aligned with your long-term goals and risk tolerance. By staying proactive and disciplined in your investment approach, you can make necessary adjustments and optimize your portfolio for better outcomes. 3.4.6 Seeking professional guidance. While building a disciplined investment approach is possible on your own, seeking professional guidance can provide valuable insights and expertise. Financial advisors and investment professionals can help you develop a personalized investment plan, provide objective advice, and keep you accountable to your goals. When seeking professional guidance, it is important to choose a financial advisor who aligns with your investment philosophy and has a track record of success. Collaborating with professionals can help you navigate complex investment decisions, stay disciplined during market turbulence, and optimize your investment strategy for long-term success. In conclusion, building a disciplined investment approach is essential for avoiding common investor mistakes and achieving long-term success in the market. By setting clear investment objectives, creating a well-defined investment plan, maintaining a long-term perspective, implementing a systematic investment approach, regularly reviewing and reassessing your investments, and seeking professional guidance when needed, you can develop the discipline necessary to navigate the ups and downs of the market and achieve your financial goals. 4. Timing the market. 4.1 The myth of market timing. Timing the market is a concept that has captivated investors for decades. The idea of buying low and selling high, of predicting the peaks and valleys of the stock market, is an alluring prospect. However, the reality is that market timing is a myth, and attempting to do so can lead to costly mistakes. The illusion of predicting market movements. Market timing is based on the belief that it is possible to accurately predict the future direction of the stock market. Investors who engage in market timing try to buy stocks when they believe the market is about to rise and sell when they anticipate a decline. However, the truth is that accurately predicting short-term market movements is nearly impossible. The stock market is influenced by a multitude of factors, including economic indicators, geopolitical events, and investor sentiment. These factors are constantly changing and can be unpredictable. Even the most experienced and knowledgeable investors struggle to consistently time the market correctly. The risks and costs of market timing. Attempting to time the market can have significant risks and costs associated with it. One of the main risks is missing out on potential gains. If an investor tries to time the market and sells their stocks during a downturn, they may miss out on the subsequent recovery and the opportunity for significant gains. Market timing also incurs costs in the form of transaction fees and taxes. Constantly buying and selling stocks to try to time the market can result in high trading costs, which can eat into investment returns. Additionally, short-term capital gains taxes may apply to profits made from frequent trading, further reducing overall returns. Long-term investing versus short-term trading. Instead of trying to time the market, a more prudent approach is to focus on long-term investing. Long-term investing involves buying and holding investments for an extended period, typically years or even decades. This strategy allows investors to benefit from the power of compounding and the long-term growth potential of the stock market. Long-term investing is based on the principle that, over time, the stock market tends to rise. While there may be short-term fluctuations and market downturns, history has shown that the market has consistently trended upward over the long term. By staying invested and riding out market volatility, investors have a higher probability of achieving their financial goals. Developing a strategic investment plan. To avoid the pitfalls of market timing, it is essential to develop a strategic investment plan. This plan should be based on a thorough understanding of your financial goals, risk tolerance, and time horizon. By aligning your investments with your objectives, you can avoid making impulsive decisions based on short-term market movements. A strategic investment plan should include a diversified portfolio that spreads risk across different asset classes and sectors. Diversification helps to mitigate the impact of market volatility and reduces the reliance on any single investment. It is also important to regularly review and rebalance your portfolio to ensure it remains aligned with your investment strategy. Additionally, it is crucial to stay informed about market trends and economic developments. However, rather than using this information to time the market, it should be used to make informed investment decisions based on a long-term perspective. Conclusion. Market timing is a myth that has led many investors astray. Attempting to predict short-term market movements is a risky and costly endeavor. Instead, investors should focus on long-term investing and develop a strategic investment plan that aligns with their financial goals. By staying disciplined, diversifying their portfolio, and avoiding impulsive decisions, investors can increase their chances of achieving long-term investment success. 4.2 The risks and costs of market timing. Market timing is the practice of trying to predict the future movements of the financial markets in order to make investment decisions. It involves buying or selling assets based on the belief that one can accurately predict when the market will rise or fall. While it may seem like a tempting strategy to maximize profits, market timing is fraught with risks and costs that can significantly impact an investor's portfolio. 4.2.1 The illusion of timing the market. One of the biggest risks of market timing is the illusion that one can consistently predict market movements. Many investors fall into the trap of believing that they have the ability to accurately time the market, only to find themselves making costly mistakes. The truth is that accurately predicting short-term market movements is extremely difficult, if not impossible, even for seasoned professionals. 4.2.2 Emotional decision-making. Market timing often leads to emotional decision-making, which can be detrimental to investment success. When investors try to time the market, they may be driven by fear or greed, making impulsive decisions based on short-term market fluctuations. This emotional rollercoaster can lead to buying high and selling low, which is the opposite of what successful investors do. Emotional decision-making can result in significant losses and hinder long-term wealth accumulation. 4.2.3 Increased transaction costs. Market timing involves frequent buying and selling of assets, which leads to increased transaction costs. Every time an investor trades, they incur brokerage fees, commissions, and other transaction costs. These costs can quickly add up and eat into an investor's returns. Moreover, frequent trading can also trigger capital gains taxes, further reducing the overall profitability of market timing strategies. 4.2.4 Missed opportunities. Another significant risk of market timing is the potential for missed opportunities. Trying to time the market requires investors to accurately predict not only when to sell but also when to buy back into the market. However, it is challenging to consistently identify the optimal entry and exit points. As a result, investors may miss out on potential gains if they are not fully invested during periods of market growth. 4.2.5 Market volatility. Market timing is particularly risky during periods of high market volatility. Volatile markets are characterized by rapid and unpredictable price movements, making it even more challenging to accurately time the market. Investors who attempt to time the market during volatile periods may find themselves exposed to significant losses if their predictions are incorrect. It is important to remember that market volatility is a normal part of investing, and trying to time the market during these periods can be extremely risky. 4.2.6 Time and effort. Successfully timing the market requires a significant amount of time and effort. It involves closely monitoring market trends, analyzing economic indicators, and staying up to date with financial news. This constant monitoring can be stressful and time-consuming, taking away from other important aspects of an investor's life. Additionally, the time and effort spent on market timing may not necessarily result in better investment returns, as the markets are influenced by a multitude of factors that are difficult to predict accurately. 4.2.7 Lack of consistency. Consistency is key to successful investing. Market timing strategies often lack consistency, as they rely on short-term predictions that may not hold true over the long term. Investors who attempt to time the market may find themselves constantly changing their investment positions, which can lead to a lack of focus and a lack of a well-defined investment strategy. Consistency in investment decisions is crucial for long-term success and wealth accumulation. 4.2.8 Long-term investing versus short-term trading. Market timing is often associated with short-term trading, where investors aim to profit from short-term price movements. However, successful investing is more focused on long-term wealth accumulation. Long-term investing allows investors to take advantage of the power of compounding and ride out short-term market fluctuations. By focusing on long-term goals and staying invested in a diversified portfolio, investors can reduce the risks associated with market timing and increase their chances of achieving their financial objectives. 4.2.9 Developing a strategic investment plan. Instead of trying to time the market, investors are better off developing a strategic investment plan based on their financial goals, risk tolerance, and time horizon. A well-structured investment plan takes into account the investor's long-term objectives and incorporates a diversified portfolio that aligns with their risk profile. By focusing on a disciplined investment approach and staying committed to their plan, investors can avoid the risks and costs associated with market timing and increase their chances of long-term investment success. In conclusion, market timing is a risky and costly investment strategy that often leads to poor investment outcomes. The illusion of accurately predicting market movements, emotional decision-making, increased transaction costs, missed opportunities, market volatility, time and effort, lack of consistency, and the focus on short-term trading are all factors that contribute to the risks and costs of market timing. Instead, investors should focus on developing a strategic investment plan that aligns with their long-term goals and stay committed to a disciplined approach to achieve investment success. 4.3 Long-term investing versus short-term trading. When it comes to investing, there are two primary approaches that investors can take: long-term investing and short-term trading. Each approach has its own advantages and disadvantages, and understanding the differences between the two is crucial for making informed investment decisions. 4.3.1 The difference between long-term investing and short-term trading. Long-term investing involves buying and holding investments for an extended period, typically years or even decades. The goal of long-term investing is to generate wealth over time by taking advantage of the power of compounding and the growth potential of the underlying assets. Investors who adopt this approach focus on the fundamentals of the investments, such as the company's financial health, industry trends, and long-term growth prospects. On the other hand, short-term trading involves buying and selling investments within a relatively short time frame, often days, weeks, or months. Traders aim to profit from short-term price fluctuations and market inefficiencies. They rely heavily on technical analysis, charts, and market indicators to make quick buying and selling decisions. 4.3.2 Benefits of long-term investing. 4.3.2.1 Compound interest and wealth accumulation. One of the key advantages of long-term investing is the power of compound interest. By reinvesting dividends or interest earned, investors can benefit from the compounding effect, where their investment grows exponentially over time. This compounding effect can significantly boost investment returns and help investors accumulate substantial wealth. 4.3.2.2 Reduce transaction costs and taxes. Long-term investors typically have lower transaction costs compared to short-term traders. Since they hold investments for an extended period, they are not frequently buying and selling, thereby reducing brokerage fees and other transaction costs. Additionally, long-term investments may qualify for more favorable tax treatment, such as long-term capital gains tax rates, which can further enhance investment returns. 4.3.2.3 Less stress and emotional decision-making. Long-term investing allows investors to take a more relaxed approach to their investments. By focusing on the long-term prospects of the investments and ignoring short-term market fluctuations, investors can avoid making impulsive decisions based on emotions. This approach helps reduce stress and allows investors to stay committed to their investment strategy even during market downturns. 4.3.3 Drawbacks of long-term investing. 4.3.3.1 Limited liquidity. One of the downsides of long-term investing is the limited liquidity of the investments. Since long-term investors hold their investments for an extended period, they may not have immediate access to their funds when needed. This lack of liquidity can be a disadvantage for investors who require quick access to their capital. 4.3.3.2 Potential missed opportunities. Long-term investors may miss out on short-term market opportunities or trends that could result in quick profits. By holding investments for the long term, investors may not be able to take advantage of short-term price movements or market inefficiencies that short-term traders actively seek. 4.3.4 Benefits of short-term trading. 4.3.4.1 Potential for quick profits. Short-term trading offers the potential for quick profits by taking advantage of short-term price movements. Traders can capitalize on market volatility and make frequent trades to generate income. By closely monitoring market trends and using technical analysis, traders aim to identify short-term opportunities and execute trades accordingly. 4.3.4.2 Flexibility and liquidity. Short-term traders have the advantage of flexibility and liquidity. They can quickly enter and exit positions, allowing them to adapt to changing market conditions or take advantage of emerging opportunities. This flexibility provides traders with the ability to manage risk more effectively and adjust their strategies as needed. 4.3.5 Drawbacks of short-term trading. 4.3.5.1 Higher transaction costs. Short-term trading involves frequent buying and selling, resulting in higher transaction costs. These costs can eat into potential profits and reduce overall investment returns. The fees associated with brokerage accounts, commissions, and other trading expenses can add up significantly over time. 4.3.5.2 Emotional decision-making. Short-term trading requires making quick decisions based on market fluctuations, which can lead to emotional decision-making. Traders may be tempted to make impulsive trades driven by fear or greed, which can result in poor investment outcomes. Emotional decision-making can lead to a lack of discipline and adherence to a well-thought-out investment strategy. 4.3.6 Finding the right approach for you. Deciding between long-term investing and short-term trading depends on various factors, including your investment goals, risk tolerance, time commitment, and financial resources. It is essential to evaluate your personal circumstances and consider the advantages and disadvantages of each approach. For investors with a long-term perspective and a focus on wealth accumulation over time, long-term investing may be the preferred strategy. This approach allows for the benefits of compound interest and reduces the impact of short-term market volatility. On the other hand, short-term trading may be suitable for individuals who have the time, expertise, and risk tolerance to actively monitor the markets and execute trades. Traders who can effectively manage risk and make informed decisions based on technical analysis may find short-term trading more appealing. Ultimately, the key to successful investing lies in developing a well-defined investment plan that aligns with your financial goals and risk tolerance. Whether you choose long-term investing or short-term trading, it is crucial to stay disciplined, avoid emotional decision-making, and continually educate yourself about the markets and investment strategies. 4.4 Developing a strategic investment plan. Developing a strategic investment plan is crucial for investors who want to navigate the complex and ever-changing landscape of the financial markets. A well-thought-out plan can help investors stay focused, make informed decisions, and achieve their long-term financial goals. In this section, we will explore the key components of a strategic investment plan and provide guidance on how to develop one that suits your individual needs. 4.4.1 Defining your investment objectives. The first step in developing a strategic investment plan is to clearly define your investment objectives. What are you trying to achieve with your investments? Are you looking to grow your wealth over the long term, generate income, or preserve capital? By identifying your goals, you can align your investment strategy accordingly. It is important to set realistic and achievable investment objectives. Consider factors such as your risk tolerance, time horizon, and financial situation. For example, if you have a longer time horizon and are comfortable with taking on more risk, you may focus on growth-oriented investments. On the other hand, if you have a shorter time horizon or a lower risk tolerance, you may prioritize capital preservation and income generation. 4.4.2 Assessing your risk tolerance. Understanding your risk tolerance is a critical aspect of developing a strategic investment plan. Risk tolerance refers to your ability and willingness to withstand fluctuations in the value of your investments. It is influenced by factors such as your financial goals, time horizon, and personal comfort with volatility. To assess your risk tolerance, consider your financial situation, investment knowledge, and past experiences with investing. Are you comfortable with the possibility of short-term losses in pursuit of long-term gains? Or do you prefer a more conservative approach with lower potential returns but also lower volatility? Once you have a clear understanding of your risk tolerance, you can align your investment strategy accordingly. A strategic investment plan should strike a balance between risk and reward, ensuring that you are comfortable with the level of risk you are taking on. 4.4.3 Asset allocation. Asset allocation is a key component of a strategic investment plan. It involves dividing your investment portfolio among different asset classes, such as stocks, bonds, and cash equivalents. The goal of asset allocation is to create a diversified portfolio that can potentially mitigate risk and maximize returns. The specific allocation of assets will depend on your investment objectives and risk tolerance. Generally, a more aggressive investor may have a higher allocation to stocks, which have historically offered higher returns but also higher volatility. A more conservative investor, on the other hand, may have a higher allocation to bonds or cash equivalents, which tend to be less volatile. It is important to periodically review and rebalance your asset allocation to ensure it remains aligned with your investment objectives. Market conditions and the performance of different asset classes can cause your portfolio to drift from its original allocation. Rebalancing involves buying or selling assets to bring your portfolio back to its target allocation. 4.4.4 Investment selection and diversification. Once you have determined your asset allocation, the next step is to select specific investments within each asset class. This involves conducting thorough research and due diligence to identify investment opportunities that align with your investment objectives and risk tolerance. Diversification is a crucial aspect of investment selection. By spreading your investments across different securities, industries, and geographic regions, you can potentially reduce the impact of any single investment on your overall portfolio. Diversification can help mitigate risk and increase the likelihood of achieving consistent returns over time. When selecting investments, consider factors such as the company's financial health, management team, competitive position, and valuation. It is also important to monitor your investments regularly and make adjustments as needed to ensure they continue to align with your investment plan. 4.4.5 Monitoring and reviewing your investment plan. Developing a strategic investment plan is not a one-time event. It requires ongoing monitoring and review to ensure it remains aligned with your goals and market conditions. Regularly reviewing your investment plan allows you to make necessary adjustments and take advantage of new opportunities or mitigate potential risks. Monitor the performance of your investments and compare it to your expectations and benchmarks. If your investments are not performing as expected, evaluate the reasons behind the underperformance and consider making changes to your portfolio. Similarly, if your investments are outperforming, assess whether it is due to skill or luck and adjust your strategy accordingly. In addition to performance monitoring, it is important to review your investment plan periodically to ensure it remains aligned with your changing financial situation, goals, and risk tolerance. Life events such as marriage, the birth of a child, or retirement can impact your investment needs and require adjustments to your plan. Conclusion. Developing a strategic investment plan is essential for investors who want to avoid common mistakes and achieve their financial goals. By defining your investment objectives, assessing your risk tolerance, and implementing a well-diversified asset allocation, you can create a plan that is tailored to your individual needs. Regular monitoring and review of your investment plan will ensure it remains aligned with your goals and market conditions. Remember, investing is a long-term journey, and a strategic investment plan can help you navigate the ups and downs of the market with confidence. 5. Chasing hot tips and trends. 5.1 The dangers of following hot tips. When it comes to investing, there is a constant stream of information and advice available to investors. From financial news outlets to social media platforms, there is no shortage of hot tips and trends that promise quick and lucrative returns. However, following these hot tips can be extremely dangerous and can lead to significant financial losses. In this section, we will explore the dangers of following hot tips and why it is important to approach investment decisions with caution and a critical mindset. 5.1.1 The illusion of easy money. One of the main reasons why investors are drawn to hot tips is the allure of easy money. The idea of making a quick profit by jumping on the latest investment trend can be tempting. However, it is important to remember that investing is not a get-rich-quick scheme. The market is unpredictable, and trends can change rapidly. Relying solely on hot tips without conducting thorough research and analysis can lead to poor investment decisions and significant financial losses. 5.1.2 Lack of reliable information. Hot tips often lack reliable and verified information. They are often based on rumors, speculation, or personal opinions rather than solid data and analysis. Following such tips without verifying the information can lead to misguided investment decisions. It is crucial for investors to rely on credible sources of information and conduct their own research before making any investment decisions. 5.1.3 Herd mentality and market manipulation. Following hot tips can also lead to a herd mentality among investors. When a particular investment or trend becomes popular, many investors rush to invest without fully understanding the risks involved. This herd mentality can create artificial demand and drive up prices, leading to market bubbles. Eventually, when the bubble bursts, investors who follow the hot tips may suffer significant losses. Moreover, the spread of hot tips can also be a result of market manipulation. Unscrupulous individuals or groups may spread false information or rumors to manipulate stock prices for their own gain. By following these hot tips, investors unknowingly become part of the manipulation and may end up losing their investments. 5.1.4 Lack of personalized investment strategy. Following hot tips often means investing in assets or sectors that may not align with an individual's investment goals or risk tolerance. Each investor has unique financial circumstances and investment objectives. Relying on hot tips without considering personal factors can lead to a mismatch between investments and individual needs. It is essential for investors to develop a personalized investment strategy based on their own financial goals, risk tolerance, and time horizon. 5.1.5 Emotional investing. Following hot tips can also trigger emotional investing, which can be detrimental to investment success. When investors act on hot tips without conducting proper research or analysis, they are more likely to make impulsive decisions driven by fear of missing out or greed. Emotional investing often leads to buying at the peak of a trend and selling at the bottom, resulting in significant losses. It is crucial for investors to remain rational and disciplined in their investment approach, focusing on long-term goals rather than short-term trends. 5.1.6 Lack of accountability. One of the dangers of following hot tips is the lack of accountability. When investors rely on hot tips and the investments turn sour, there is no one to hold accountable for the losses. Hot tips are often spread anonymously or by individuals who are not financial professionals. This lack of accountability can leave investors feeling helpless and unable to seek recourse for their losses. 5.1.7 Building a solid investment strategy. To avoid the dangers of following hot tips, it is important for investors to build a solid investment strategy based on thorough research, analysis, and a long-term perspective. Here are some key steps to consider. Conduct thorough research. Invest time and effort in understanding the fundamentals of the investment, including the company's financial health, industry trends, and competitive landscape. Diversify your portfolio. Instead of relying on a single hot tip, diversify your investments across different asset classes and sectors. This helps to spread the risk and minimize the impact of any single investment. Set realistic goals. Define your investment goals and align your investment strategy accordingly. Setting realistic and achievable goals will help you stay focused and avoid chasing unrealistic returns. Seek professional advice. Consider working with a qualified financial advisor who can provide personalized guidance based on your individual circumstances and goals. A professional can help you navigate through the noise of hot tips and make informed investment decisions. Stay disciplined, stick to your investment plan and avoid making impulsive decisions based on short-term trends or hot tips. Remember that investing is a long-term journey, and success comes from staying disciplined and patient. By following these steps and avoiding the dangers of following hot tips, investors can increase their chances of making sound investment decisions and achieving their financial goals. 5.2 Understanding the risks of trend investing. Trend investing is a strategy that involves identifying and capitalizing on market trends. It is based on the belief that certain stocks, sectors, or asset classes will continue to perform well in the future based on their recent performance. While trend investing can be tempting, it is important for investors to understand the risks associated with this approach. 5.2.1 The allure of trend investing. Trend investing can be appealing to investors because it offers the potential for high returns in a relatively short period of time. When a particular stock or sector is experiencing a strong upward trend, it can be tempting to jump on the bandwagon and invest in the hope of riding the wave of success. Additionally, trend investing is often fueled by the fear of missing out, FOMO. When investors see others profiting from a particular trend, they may feel compelled to join in, fearing that they will miss out on potential gains if they don't act quickly. 5.2.2 The risks of chasing trends. While trend investing can be profitable, it is important to recognize the inherent risks involved. One of the main risks is that trends can be unpredictable and short-lived. What may seem like a promising trend today could quickly reverse direction, leaving investors with significant losses. Another risk of trend investing is that it can lead to herd mentality. When a trend becomes popular, more and more investors jump on board, driving up prices artificially. This can create a bubble that eventually bursts, resulting in a sharp decline in prices. Investors who are late to the trend may end up buying at the peak and suffering significant losses when the trend reverses. Furthermore, trend investing often involves a high level of speculation and can be influenced by market manipulation or external factors. It is important for investors to conduct thorough research and analysis before making investment decisions based solely on trends. 5.2.3 The importance of fundamental analysis. To mitigate the risks associated with trend investing, it is crucial for investors to incorporate fundamental analysis into their decision-making process. Fundamental analysis involves evaluating the financial health and performance of a company or asset, rather than solely relying on recent price movements. By conducting fundamental analysis, investors can gain a deeper understanding of the underlying value and potential of an investment. This analysis includes examining financial statements, assessing the competitive landscape, evaluating management teams, and considering industry trends. By focusing on the fundamentals, investors can make more informed decisions and avoid being solely influenced by short-term trends. 5.2.4 Diversification is a risk management strategy. Diversification is a key risk management strategy that can help investors mitigate the risks associated with trend investing. By spreading investments across different asset classes, sectors, and geographic regions, investors can reduce their exposure to the volatility of any single trend. Diversification allows investors to capture the potential upside of different trends while minimizing the impact of any one trend going sour. By having a well-diversified portfolio, investors can protect themselves from the potential losses that can occur when a trend reverses. 5.2.5 Staying disciplined and avoiding emotional investing. One of the biggest challenges in trend investing is staying disciplined and avoiding emotional decision-making. When investors see a trend gaining momentum, it can be tempting to abandon their investment strategy and chase after quick profits. However, this type of emotional investing can lead to poor decision-making and increased risk. To avoid falling into this trap, it is important for investors to stick to their investment plan and remain disciplined. This means not getting caught up in the hype of a trend and making decisions based on thorough analysis and research. By staying disciplined, investors can avoid making impulsive decisions that could lead to significant losses. 5.2.6 Monitoring and adjusting trend investments. While trend investing can be risky, it doesn't mean that investors should completely avoid it. Instead, it is important to monitor trend investments closely and be prepared to adjust the portfolio as needed. Investors should regularly review their trend investments and assess whether the underlying fundamentals still support the investment thesis. If the trend starts to show signs of weakening or the fundamentals deteriorate, it may be time to consider reducing or exiting the investment. Additionally, investors should set clear exit strategies and stick to them. This can help prevent emotional decision-making and ensure that investments are managed in a disciplined manner. Conclusion. Trend investing can be a tempting strategy for investors looking for quick profits. However, it is important to understand the risks involved and approach trend investing with caution. By incorporating fundamental analysis, diversification, and disciplined decision-making, investors can navigate the risks of trend investing and increase their chances of long-term investment success. 5.3 Identifying sustainable investment opportunities. When it comes to investing, one of the key factors for success is the ability to identify sustainable investment opportunities. These are investments that have the potential to generate long-term returns and withstand market fluctuations. In this section, we will explore the importance of identifying sustainable investment opportunities and provide some strategies to help investors make informed decisions. 5.3.1 Understanding sustainable investments. Sustainable investments, also known as socially responsible investments or impact investments, are investments that not only aim to generate financial returns but also have a positive impact on society and the environment. These investments focus on companies that prioritize environmental, social, and governance (ESG) factors in their operations. Investing in sustainable companies can provide several benefits. First, it aligns your investments with your values and beliefs, allowing you to support companies that are making a positive difference in the world. Second, sustainable companies often have a competitive advantage as they are better positioned to adapt to changing market conditions and regulatory requirements. Finally, sustainable investments can offer attractive long-term returns as they are more likely to attract investors who prioritize ESG factors. 5.3.2 Researching sustainable companies. To identify sustainable investment opportunities, investors need to conduct thorough research. This involves analyzing a company's financial performance, as well as its ESG practices. Here are some key steps to consider when researching sustainable companies. Financial analysis. Start by evaluating the company's financial health, including its revenue growth, profitability, and debt levels. Look for companies with a strong track record of financial performance and a solid balance sheet. ESG analysis. Assess the company's ESG practices by examining its environmental impact, social responsibility initiatives, and corporate governance structure. Look for companies that prioritize sustainability, have clear ESG policies in place, and regularly report on their progress. Industry analysis. Consider the industry in which the company operates. Look for industries that are aligned with sustainable practices and have long-term growth potential. For example, renewable energy, clean technology, and healthcare are sectors that often offer sustainable investment opportunities. Stakeholder engagement. Evaluate how the company engages with its stakeholders, including employees, customers, and communities. Look for companies that prioritize stakeholder interests and have a positive reputation among their stakeholders. Third-party ratings. Consider utilizing third-party ratings and rankings to assess a company's sustainability performance. Organizations such as the Dow Jones Sustainability Index, MSCI ESG ratings, and the Carbon Disclosure Project provide valuable insights into a company's ESG practices. 5.3.3 Strategies for identifying sustainable investments. Identifying sustainable investment opportunities requires a combination of research, analysis, and a long-term perspective. Here are some strategies to help investors in their quest for sustainable investments. Set investment criteria. Define your investment criteria based on your values and financial goals. Determine the level of ESG integration you are comfortable with in the industries or sectors you want to focus on. This will help narrow down your investment options and guide your research. Stay informed. Keep up to date with the latest trends and developments in sustainable investing. Attend conferences, read industry reports, and follow reputable sources of information to stay informed about emerging sustainable investment opportunities. Engage with companies. Consider engaging with companies directly to gain a deeper understanding of their sustainability practices. Attend shareholder meetings, ask questions, and voice your concerns. Engaging with companies can provide valuable insights and help you make more informed investment decisions. Diversify your portfolio. Diversification is key to managing risk in any investment portfolio. Spread your investments across different asset classes, sectors, and geographies to reduce the impact of any single investment. This will help you capture the potential upside of sustainable investments while mitigating potential downside risks. Consider impact investing. Impact investing goes beyond traditional sustainable investing by actively seeking investments that generate measurable social and environmental impact alongside financial returns. Consider allocating a portion of your portfolio to impact investments if you are passionate about making a positive difference in the world. Evaluate long-term potential. Look for companies that have a long-term vision and are well-positioned to capitalize on emerging trends. Consider factors such as technological advancements, regulatory changes, and shifting consumer preferences when evaluating the long-term potential of an investment. Conclusion. Identifying sustainable investment opportunities requires a combination of financial analysis, ESG research, and a long-term perspective. By conducting thorough research, staying informed, and following a disciplined investment approach, investors can identify investments that align with their values and have the potential to generate long-term returns. Remember, sustainable investing is not just about making money, it's about making a positive impact on the world. 5.4 Creating a diversified investment portfolio. Diversification is a fundamental principle of successful investing. It involves spreading your investments across different asset classes, sectors, and geographic regions to reduce risk and maximize potential returns. Creating a diversified investment portfolio is crucial for protecting your capital and achieving long-term financial goals. 5.4.1 Understanding the importance of diversification. Diversification is often referred to as the only free lunch in investing. It is a strategy that aims to minimize the impact of any single investment on your overall portfolio. By diversifying, you can potentially reduce the volatility of your portfolio and increase the likelihood of achieving consistent returns over time. The primary goal of diversification is to avoid putting all your eggs in one basket. By spreading your investments across different asset classes, such as stocks, bonds, real estate, and commodities, you can reduce the risk of significant losses if one particular asset class performs poorly. Diversification also extends to investing in different sectors, such as technology, healthcare, finance, and consumer goods, as each sector may perform differently under various market conditions. 5.4.2 Common mistakes in portfolio diversification. While diversification is a powerful investment strategy, there are common mistakes that investors make when attempting to create a diversified portfolio. These mistakes can undermine the effectiveness of diversification and potentially expose investors to unnecessary risks. It is essential to be aware of these mistakes and take steps to avoid them. 5.4.2.1 Overconcentration in a single asset or sector. One common mistake is overconcentration in a single asset or sector. Some investors may become overly confident in a particular investment or sector and allocate a significant portion of their portfolio to it. While this approach can yield substantial gains if the investment performs well, it also exposes the investor to significant losses if the investment underperforms or the sector experiences a downturn. It is crucial to avoid overconcentration and instead allocate investments across a range of assets and sectors to mitigate risk. 5.4.2.2 Lack of geographic diversification. Another mistake is neglecting geographic diversification. Investing solely in one country or region can expose your portfolio to country-specific risks, such as political instability, economic downturns, or regulatory changes. By diversifying across different countries and regions, you can reduce the impact of these risks and potentially benefit from the growth of different economies. 5.4.2.3 Ignoring asset class diversification. Some investors may focus solely on one asset class, such as stocks, and neglect other asset classes like bonds, real estate, or commodities. This lack of asset class diversification can leave the portfolio vulnerable to market fluctuations and limit potential returns. It is essential to consider a mix of asset classes that align with your risk tolerance and investment objectives. 5.4.2.4 Neglecting risk-return trade-off. Investors often make the mistake of chasing high returns without considering the associated risks. While it is natural to seek higher returns, it is crucial to understand that higher returns often come with higher risks. Neglecting the risk-return trade-off can lead to an imbalanced portfolio that is either too conservative or too aggressive. It is important to strike a balance between risk and return by diversifying your investments across different risk profiles. 5.4.3 Diversifying across asset classes and sectors. To create a well-diversified investment portfolio, it is essential to allocate your investments across different asset classes and sectors. This approach helps to reduce the impact of any single investment or sector on your overall portfolio performance. Here are some key considerations when diversifying across asset classes and sectors. 5.4.3.1 Asset class diversification. Asset class diversification involves allocating your investments across different types of assets, such as stocks, bonds, real estate, and commodities. Each asset class has its own risk and return characteristics, and they tend to perform differently under various market conditions. By diversifying across asset classes, you can potentially reduce the overall risk of your portfolio and increase the likelihood of achieving consistent returns. 5.4.3.2 Sector diversification. Sector diversification involves spreading your investments across different sectors of the economy, such as technology, healthcare, finance, and consumer goods. Each sector may perform differently based on factors such as economic conditions, industry trends, and regulatory changes. By diversifying across sectors, you can reduce the impact of any single sector's performance on your portfolio and potentially benefit from the growth of multiple sectors. 5.4.3.3 Geographic diversification. Geographic diversification involves investing in different countries and regions. By spreading your investments across different geographic areas, you can reduce the impact of country-specific risks and potentially benefit from the growth of different economies. Geographic diversification can also provide exposure to different currencies, which can be beneficial in managing currency risk. 5.4.4 Rebalancing your investment portfolio. Once you have created a diversified investment portfolio, it is important to regularly review and rebalance your portfolio to maintain the desired asset allocation. Rebalancing involves adjusting the weights of different investments within your portfolio to bring them back in line with your target allocation. Market fluctuations can cause the value of different investments to change over time, leading to a shift in your portfolio's asset allocation. Rebalancing allows you to sell investments that have become overweighted and buy investments that have become underweighted, ensuring that your portfolio remains aligned with your investment goals and risk tolerance. Rebalancing also helps to take advantage of market opportunities. When certain asset classes or sectors have performed well, they may become overweighted in your portfolio. By rebalancing, you can sell some of those investments and allocate the proceeds to other asset classes or sectors that may be undervalued, potentially capturing future growth opportunities. In conclusion, creating a diversified investment portfolio is crucial for managing risk and maximizing potential returns. By spreading your investments across different asset classes, sectors, and geographic regions, you can reduce the impact of any single investment on your overall portfolio. Avoiding common mistakes in portfolio diversification and regularly rebalancing your portfolio will help you stay on track towards achieving your long-term financial goals. 6. Ignoring risk management. 6.1 The importance of risk management in investing. Risk management is a crucial aspect of successful investing. It involves identifying, assessing, and mitigating potential risks that could impact your investment portfolio. By implementing effective risk management strategies, investors can protect their capital, minimize losses, and increase the likelihood of achieving their financial goals. 6.1.1 Understanding risk in investing. Investing inherently involves risk. The value of investments can fluctuate, and there is always the possibility of losing money. However, not all risks are the same. Some risks are inherent to the market, such as economic downturns or geopolitical events, while others are specific to individual investments, such as company-specific risks or industry risks. Understanding the different types of risks is essential for effective risk management. Market risk refers to the overall volatility and uncertainty of the market, while specific risks are associated with individual investments. By identifying and assessing these risks, investors can make informed decisions and develop appropriate risk management strategies. 6.1.2 The benefits of risk management. Implementing risk management strategies offers several benefits to investors. Firstly, it helps protect capital by minimizing potential losses. By diversifying investments across different asset classes and sectors, investors can spread their risk and reduce the impact of any single investment's poor performance. Secondly, risk management allows investors to maintain a disciplined approach to investing. By setting clear risk tolerance levels and adhering to them, investors can avoid making impulsive decisions based on short-term market fluctuations. This helps to prevent emotional decision-making, which can often lead to poor investment choices. Furthermore, effective risk management can enhance long-term returns. By carefully managing risk, investors can optimize their portfolio's risk-return trade-off. This means finding the right balance between risk and potential reward, ensuring that the portfolio is aligned with the investor's financial goals and time horizon. 6.1.3 Common risk management mistakes to avoid. While risk management is crucial, it is essential to avoid common mistakes that can undermine its effectiveness. Here are some common risk management mistakes to be aware of. 6.1.3.1 Neglecting to define risk tolerance. One of the most significant mistakes investors make is failing to define their risk tolerance. Risk tolerance refers to an investor's ability and willingness to withstand potential losses. Without a clear understanding of their risk tolerance, investors may take on too much risk or become overly conservative, both of which can hinder their investment performance. To avoid this mistake, investors should assess their financial situation, investment goals, and time horizon. They should consider factors such as their age, income, and financial obligations to determine their risk tolerance. This will help them align their investment decisions with their risk tolerance level. 6.1.3.2 Lack of diversification. Another common risk management mistake is a lack of diversification. Concentrating investments in a single asset class, sector, or geographic region can expose investors to unnecessary risk. If one investment performs poorly, the entire portfolio may suffer significant losses. Diversification involves spreading investments across different asset classes, such as stocks, bonds, and real estate, as well as different sectors and regions. This helps to reduce the impact of any single investment's poor performance and provides a more balanced risk-return profile. 6.1.3.3 Failing to monitor and rebalance. Investors must regularly monitor their investment portfolio and make necessary adjustments to maintain their desired risk level. Failing to do so can result in an unbalanced portfolio that may not align with the investor's risk tolerance or financial goals. Monitoring involves regularly reviewing the performance of individual investments, as well as the overall portfolio. If certain investments become overvalued or underperforming, adjustments may be needed to rebalance the portfolio. This ensures that the portfolio remains aligned with the investor's risk tolerance and investment objectives. 6.1.3.4 Overlooking stop-loss orders and limit orders. Stop-loss orders and limit orders are valuable tools for managing risk in investing. A stop-loss order is an instruction to sell a security if its price falls below a specified level, limiting potential losses. On the other hand, a limit order is an instruction to buy or sell a security at a specific price or better. By utilizing stop-loss orders and limit orders, investors can protect their investments from significant losses and avoid emotional decision-making. These orders help to enforce discipline and ensure that investment decisions are based on predetermined criteria rather than short-term market fluctuations. 6.1.4 Implementing a risk management strategy. To effectively manage risk in investing, it is essential to develop and implement a comprehensive risk management strategy. Here are some key steps to consider. Define your risk tolerance. Assess your financial situation, investment goals, and time horizon to determine your risk tolerance level. Diversify your portfolio. Spread your investments across different asset classes, sectors, and regions to reduce the impact of any single investment's poor performance. Regularly monitor your portfolio. Review the performance of individual investments and the overall portfolio to ensure it remains aligned with your risk tolerance and investment objectives. Utilize stop-loss orders and limit orders. Consider using these tools to protect your investments from significant losses and avoid emotional decision-making. Stay informed. Stay updated on market trends, economic indicators, and relevant news that may impact your investments. This will help you make informed decisions and adjust your risk management strategy accordingly. By following these steps and continuously evaluating and adjusting your risk management strategy, you can effectively manage risk and increase the likelihood of achieving your investment goals. In conclusion, risk management is a critical aspect of successful investing. By understanding and managing different types of risks, investors can protect their capital, maintain a disciplined approach, and optimize their portfolio's risk-return trade-off. By avoiding common risk management mistakes and implementing a comprehensive risk management strategy, investors can increase their chances of long-term investment success. 6.2 Common risk management mistakes to avoid. Risk management is a crucial aspect of successful investing. It involves identifying, assessing, and mitigating potential risks that could impact your investment portfolio. While it is essential to have a risk management strategy in place, many investors make common mistakes that can undermine their efforts to protect their investments. In this section, we will discuss some of these common risk management mistakes and provide guidance on how to avoid them. 6.2.1 Failing to define risk tolerance. One of the most significant risk management mistakes investors make is failing to define their risk tolerance. Risk tolerance refers to the level of risk an investor is willing and able to take on. It is influenced by factors such as financial goals, time horizon, and personal comfort with volatility. Without a clear understanding of your risk tolerance, you may find yourself making impulsive investment decisions or taking on more risk than you can handle. To avoid this mistake, take the time to assess your risk tolerance objectively. Consider your financial goals, investment time frame, and your ability to withstand potential losses. It is crucial to strike a balance between risk and reward that aligns with your individual circumstances. By defining your risk tolerance, you can make more informed investment decisions and avoid taking on excessive risk. 6.2.2 Neglecting to diversify. Another common risk management mistake is neglecting to diversify your investment portfolio. Diversification involves spreading your investments across different asset classes, sectors, and geographic regions. It helps to reduce the impact of any single investment on your overall portfolio and can mitigate the risk of significant losses. By failing to diversify, you expose yourself to concentration risk, where a significant portion of your portfolio is invested in a single asset or sector. If that asset or sector experiences a downturn, your entire portfolio could suffer. To avoid this mistake, ensure that your portfolio is well diversified. Consider investing in a mix of stocks, bonds, real estate, and other asset classes. Additionally, diversify within each asset class by investing in different sectors and geographic regions. 6.2.3 Overlooking the importance of stop-loss orders. Stop-loss orders are an essential tool in risk management. They allow you to set a predetermined price at which you will sell a security to limit potential losses. However, many investors overlook the importance of using stop-loss orders or fail to use them effectively. One common mistake is setting stop-loss orders too close to the current market price. While it is essential to protect your investments, setting stop-loss orders too close can result in unnecessary selling triggered by short-term market fluctuations. On the other hand, setting stop-loss orders too far away may expose you to significant losses if the market experiences a sharp decline. To avoid this mistake, take the time to analyze the historical price movements of the security you are investing in. Consider the volatility of the market and set stop-loss orders at a level that provides a reasonable buffer while still protecting your investments. Regularly review and adjust your stop-loss orders as market conditions change. 6.2.4 Ignoring the importance of limit orders. In addition to stop-loss orders, limit orders are another valuable tool in risk management. Limit orders allow you to set a specific price at which you are willing to buy or sell a security. By using limit orders, you can avoid buying or selling at unfavorable prices and protect yourself from sudden market fluctuations. However, many investors make the mistake of ignoring the importance of limit orders or not using them effectively. They may place market orders, which execute at the current market price, without considering the potential impact on their investment returns. To avoid this mistake, always use limit orders when buying or selling securities. Set a specific price at which you are comfortable executing the trade, taking into account factors such as the security's historical price movements and market conditions. By using limit orders, you can ensure that you are buying or selling at prices that align with your investment objectives. 6.2.5 Failing to regularly review and adjust risk management strategies. Lastly, a common risk management mistake is failing to regularly review and adjust your risk management strategies. The investment landscape is constantly evolving, and what may have been an effective risk management strategy in the past may no longer be suitable for current market conditions. To avoid this mistake, make it a habit to regularly review your risk management strategies. Stay informed about market trends, economic indicators, and any changes in the regulatory environment that may impact your investments. Consider working with a financial advisor who can provide guidance and help you adjust your risk management strategies as needed. In conclusion, avoiding common risk management mistakes is crucial for successful investing. By defining your risk tolerance, diversifying your portfolio, using stop-loss and limit orders effectively, and regularly reviewing and adjusting your risk management strategies, you can protect your investments and increase your chances of achieving your financial goals. Remember, investing involves risk, but with proper risk management, you can navigate the market more confidently and reduce the impact of potential pitfalls. 6.3 Using stop-loss orders and limit orders. In the world of investing, managing risk is crucial to long-term success. One effective way to mitigate risk is by using stop-loss orders and limit orders. These tools can help investors protect their investments and make more informed decisions. 6.3.1 Understanding stop-loss orders. A stop-loss order is a type of order that is placed with a broker to sell a security if it reaches a certain price. The purpose of a stop-loss order is to limit potential losses by automatically triggering a sale when the price of the security falls below a predetermined level. Stop-loss orders are particularly useful in volatile markets or when investors are unable to constantly monitor their investments. By setting a stop-loss order, investors can protect themselves from significant losses in case the market takes an unexpected turn. 6.3.2 Benefits of stop-loss orders. Using stop-loss orders offers several benefits to investors. Firstly, it helps to remove emotions from investment decisions. Emotions can often cloud judgment and lead to impulsive actions, such as holding on to a losing investment for too long. By setting a stop-loss order, investors can stick to their predetermined exit strategy and avoid making emotional decisions. Secondly, stop-loss orders provide a level of protection against market downturns. In volatile markets, prices can fluctuate rapidly, and it can be challenging to react quickly enough to limit losses. By using stop-loss orders, investors can ensure that their investments are automatically sold if the price falls below a certain threshold, protecting them from further losses. Lastly, stop-loss orders can help investors maintain discipline and stick to their investment plan. It is easy to get caught up in the excitement of a rising market and hold on to investments for longer than intended. By setting stop-loss orders, investors can enforce their predetermined exit strategy and avoid the temptation to hold on to investments for too long. 6.3.3 Implementing stop-loss orders. To implement a stop-loss order, investors need to determine the appropriate level at which they are comfortable selling their investment. This level should be based on careful analysis and consideration of the investment's risk profile, market conditions, and personal risk tolerance. It is important to note that stop-loss orders are not foolproof and do not guarantee that an investor will sell at the desired price. In fast-moving markets or during periods of extreme volatility, the execution price of a stop-loss order may differ from the specified price. This is known as slippage and can occur when there is a sudden and significant change in the market price. To minimize the risk of slippage, investors can consider using a stop-limit order instead of a traditional stop-loss order. A stop-limit order combines the features of a stop-loss order and a limit order. It specifies both a stop price and a limit price. Once the stop price is reached, the order becomes a limit order, and the investor's shares are sold at the limit price or better. 6.3.4 Understanding limit orders. While stop-loss orders are designed to protect against losses, limit orders are used to set a specific price at which an investor is willing to buy or sell a security. A limit order allows investors to control the price at which they enter or exit a position. When placing a limit order to buy, investors specify the maximum price they are willing to pay for a security. If the market price reaches or falls below the specified price, the order is executed. On the other hand, when placing a limit order to sell, investors specify the minimum price they are willing to accept for a security. If the market price reaches or exceeds the specified price, the order is executed. Limit orders can be particularly useful in situations where investors want to buy or sell a security at a specific price but are not in a rush to execute the trade. By setting a limit order, investors can wait for the market to reach their desired price, potentially maximizing their gains or minimizing their losses. 6.3.5 Benefits of limit orders. Using limit orders offers several benefits to investors. Firstly, it allows investors to have more control over their trades. By setting a specific price at which they are willing to buy or sell, investors can avoid making impulsive decisions based on short-term market fluctuations. Secondly, limit orders can help investors achieve better execution prices. When placing a limit order, investors have the opportunity to buy at a lower price or sell at a higher price than the current market price. This can result in improved returns and reduced transaction costs. Lastly, limit orders can be particularly useful in illiquid markets or when trading large volumes of securities. By setting a limit order, investors can ensure that their trades are executed at their desired price, even if there is limited liquidity in the market. 6.3.6 Implementing limit orders. To implement a limit order, investors need to determine the appropriate price at which they are willing to buy or sell a security. This price should be based on careful analysis and consideration of the investment's intrinsic value, market conditions, and personal investment objectives. It is important to note that limit orders do not guarantee execution. If the market price does not reach the specified limit price, the order may remain unfilled. In such cases, investors may need to reassess their limit price or consider alternative strategies. When using limit orders, it is also important to be mindful of the time frame in which the order is valid. Limit orders can have an expiration date, after which they are automatically cancelled if not executed. Investors should ensure that the time frame aligns with their investment objectives and market conditions. In conclusion, stop-loss orders and limit orders are valuable tools that can help investors manage risk and make more informed investment decisions. By using stop-loss orders, investors can protect themselves from significant losses and remove emotions from their decision-making process. On the other hand, limit orders allow investors to set specific prices at which they are willing to buy or sell, providing more control over their trades. By incorporating these order types into their investment strategies, investors can enhance their risk management practices and increase their chances of long-term investment success. 6.4 Implementing a risk management strategy. Implementing a risk management strategy is crucial for investors who want to protect their capital and minimize potential losses. While investing always carries some level of risk, having a well-defined risk management plan can help investors navigate the uncertainties of the market and make informed decisions. In this section, we will explore the importance of implementing a risk management strategy and discuss some key principles and techniques that can be used to effectively manage risk in your investment portfolio. 6.4.1 Understanding risk management. Risk management is the process of identifying, assessing, and prioritizing risks, and then taking appropriate actions to mitigate or minimize those risks. In the context of investing, risk management involves evaluating the potential risks associated with different investment opportunities and implementing strategies to protect against those risks. The goal of risk management is not to eliminate risk entirely, but rather to manage it in a way that aligns with your investment objectives and risk tolerance. 6.4.2 Assessing risk tolerance. Before implementing a risk management strategy, it is important to assess your risk tolerance. Risk tolerance refers to your ability and willingness to take on risk in your investment portfolio. It is influenced by factors such as your financial situation, investment goals, time horizon, and personal preferences. Understanding your risk tolerance will help you determine the level of risk you are comfortable with and guide your decision-making process when it comes to managing risk. 6.4.3 Diversification. One of the most effective risk management techniques is diversification. Diversification involves spreading your investments across different asset classes, sectors, and geographic regions. By diversifying your portfolio, you can reduce the impact of any single investment on your overall portfolio performance. This is because different investments tend to perform differently under various market conditions. Diversification helps to mitigate the risk of significant losses in case one investment underperforms. 6.4.4 Asset allocation. Asset allocation is another important aspect of risk management. It involves determining the optimal mix of asset classes, such as stocks, bonds, and cash, in your investment portfolio. The goal of asset allocation is to balance risk and return based on your investment objectives and risk tolerance. By diversifying your investments across different asset classes, you can potentially reduce the overall risk of your portfolio while still aiming for a reasonable level of return. 6.4.5 Setting stop-loss orders. Stop-loss orders are a risk management tool that can help protect your investments from significant losses. A stop-loss order is an instruction to sell a security if it reaches a predetermined price level. By setting a stop-loss order, you can limit your potential losses by automatically selling a security if its price falls below a certain threshold. This can be particularly useful in volatile markets or when investing in individual stocks. 6.4.6 Using position sizing. Position sizing is a risk management technique that involves determining the appropriate size of each investment position in your portfolio. It is based on the principle of allocating a specific percentage of your total portfolio value to each investment. By properly sizing your positions, you can limit the potential impact of any single investment on your overall portfolio performance. This can help protect your capital and reduce the risk of significant losses. 6.4.7 Regular portfolio review. Implementing a risk management strategy requires regular monitoring and review of your investment portfolio. It is important to regularly assess the performance of your investments and make adjustments as needed. This includes reviewing your asset allocation, diversification, and risk exposure. By regularly reviewing your portfolio, you can identify any potential risks or weaknesses and take appropriate actions to mitigate them. 6.4.8 Staying informed. Staying informed about the market and economic conditions is essential for effective risk management. By keeping up to date with relevant news, economic indicators, and industry trends, you can make more informed investment decisions. This includes monitoring the performance of your investments, staying aware of any changes in market conditions, and being prepared to adjust your risk management strategy accordingly. 6.4.9 Seeking professional advice. Implementing a risk management strategy can be complex, especially for novice investors. Seeking professional advice from a financial advisor or investment manager can provide valuable insights and guidance. A professional can help you assess your risk tolerance, develop a customized risk management plan, and provide ongoing support and advice. They can also help you navigate through challenging market conditions and make informed decisions based on your individual circumstances. Conclusion. Implementing a risk management strategy is essential for investors who want to protect their capital and achieve their investment goals. By understanding your risk tolerance, diversifying your portfolio, using risk management tools such as stop-loss orders, and regularly reviewing your investments, you can effectively manage risk and increase the likelihood of long-term investment success. Remember, investing involves risk, but with a well-defined risk management strategy, you can navigate the market with confidence and minimize potential pitfalls. 7. Lack of patience and discipline. 7.1 The role of patience in successful investing. Patience is a virtue that is often overlooked in the fast-paced world of investing. In today's society, where instant gratification is the norm, many investors are tempted to make quick decisions in the hopes of reaping immediate rewards. However, successful investing requires a different mindset, one that embraces patience and understands the long-term nature of the market. The importance of patience. Patience is a crucial attribute for successful investors because it allows them to stay focused on their long-term goals and avoid making impulsive decisions based on short-term market fluctuations. The stock market is known for its volatility, and prices can fluctuate wildly from day to day. It is easy to get caught up in the excitement of a rising market or the panic of a downturn. However, patient investors understand that these short-term fluctuations are just noise in the grand scheme of things. By maintaining a patient approach, investors can avoid the temptation to buy or sell based on short-term market movements. Instead, they can focus on the underlying fundamentals of the companies they invest in and make informed decisions based on long-term trends and prospects. Patience allows investors to ride out market downturns and take advantage of buying opportunities when prices are low. Avoiding impulsive investment decisions. Impulsivity is the enemy of successful investing. It often leads to buying high and selling low, which is the exact opposite of what investors should be doing. Impulsive decisions are typically driven by emotions such as fear, greed, or the desire to chase quick profits. These emotions can cloud judgment and lead to poor investment choices. Patience helps investors overcome these emotional impulses. It allows them to step back, assess the situation objectively, and make rational decisions based on careful analysis and research. Patient investors understand that investing is a marathon, not a sprint, and that short-term gains are often outweighed by long-term losses. Sticking to your investment plan. A well-thought-out investment plan is essential for success in the market. It outlines your financial goals, risk tolerance, and investment strategy. However, even the best investment plan is useless if it is not followed consistently. This is where patience comes into play. Patience enables investors to stick to their investment plan, even when the market is volatile or when others are panicking. It allows them to stay focused on their long-term goals and resist the temptation to deviate from their strategy based on short-term market movements. By staying disciplined and patient, investors can avoid making knee-jerk reactions that could jeopardize their financial future. Developing discipline in investment practices. Discipline is a key component of successful investing, and patience is a fundamental aspect of developing discipline. It takes discipline to resist the urge to make impulsive decisions, to stick to your investment plan, and to avoid chasing after the latest hot investment trend. Developing discipline in investment practices requires a commitment to long-term thinking and a willingness to stay the course, even when faced with adversity. It means having the patience to wait for the right opportunities and the discipline to avoid taking unnecessary risks. It also involves regularly reviewing and adjusting your investment plan as needed, but doing so in a thoughtful and deliberate manner. The rewards of patience. While patience may not provide instant gratification, it is often rewarded in the long run. Patient investors have the opportunity to benefit from the power of compounding, which allows their investments to grow exponentially over time. By staying invested and allowing their assets to compound, patient investors can potentially achieve significant wealth accumulation. Furthermore, patience allows investors to take advantage of market cycles and buy assets at discounted prices during market downturns. By resisting the urge to panic sell and instead buying when others are fearful, patient investors can position themselves for substantial gains when the market eventually recovers. Conclusion. Patience is a vital attribute for successful investors. It allows them to stay focused on their long-term goals, avoid impulsive decisions, stick to their investment plan, and develop discipline in their investment practices. While it may be tempting to seek instant gratification in the market, patient investors understand that true wealth accumulation takes time. By embracing patience, investors can increase their chances of achieving long-term financial success. 7.2 Avoiding impulsive investment decisions. Impulsive investment decisions can be detrimental to your financial success as an investor. Acting on emotions or making hasty decisions without careful consideration can lead to poor investment outcomes and significant losses. In this section, we will explore the dangers of impulsive decision-making and provide strategies to help you avoid making these costly mistakes. The impact of impulsive decisions. Impulsive investment decisions are often driven by emotions such as fear, greed, or excitement. These emotions can cloud your judgment and lead you to make irrational choices that go against your long-term investment goals. When you act impulsively, you may be more likely to buy or sell investments based on short-term market fluctuations or the latest news, rather than considering the fundamentals of the investment. One common impulsive decision is panic selling during market downturns. When the market experiences a significant decline, it is natural to feel anxious and want to protect your investments. However, selling in a panic can lock in losses and prevent you from benefiting from a potential market recovery. Similarly, impulsive buying based on the fear of missing out (FOMO) can lead to purchasing overvalued assets that may not align with your investment strategy. Strategies to avoid impulsive decisions. To avoid impulsive investment decisions, it is crucial to develop a disciplined approach to investing. Here are some strategies to help you stay on track. 1. Set clear investment goals. Having clear investment goals can provide you with a framework for making rational decisions. Define your objectives, whether they are long-term wealth accumulation, retirement planning, or funding a specific financial goal. By understanding your goals, you can align your investment decisions with your overall financial plan and avoid being swayed by short-term market fluctuations. 2. Create an investment plan. Developing a well-thought-out investment plan can help you stay focused and avoid making impulsive decisions. Your plan should outline your asset allocation strategy, risk tolerance, and investment time horizon. By having a plan in place, you can resist the temptation to deviate from your strategy based on short-term market movements. 3. Conduct thorough research. Before making any investment decisions, conduct thorough research on the asset or company you are considering. Understand the fundamentals, evaluate the financial health, and assess the long-term prospects. By having a solid understanding of the investment, you can make informed decisions based on facts rather than emotions. 4. Practice patience. Patience is a virtue in investing. Avoid the urge to make quick decisions based on short-term market movements. Instead, take a long-term perspective and focus on the fundamentals of your investments. Remember that successful investing is a marathon, not a sprint. 5. Implement a cooling-off period. If you find yourself tempted to make an impulsive investment decision, implement a cooling-off period. Step away from the situation and give yourself time to think rationally. This can help you avoid acting on emotions and make more logical choices. 6. Seek advice from professionals. Consulting with a financial advisor or investment professional can provide you with valuable guidance and help you avoid impulsive decisions. A professional can offer an objective perspective, provide insights into market trends, and help you stay focused on your long-term goals. 7. Practice self-discipline. Developing self-discipline is crucial in avoiding impulsive investment decisions. Stick to your investment plan and resist the temptation to deviate from your strategy based on short-term market movements or the latest investment fads. Remember that successful investing requires discipline and a long-term perspective. Conclusion. Avoiding impulsive investment decisions is essential for long-term investment success. By understanding the impact of impulsive decisions and implementing strategies to avoid them, you can stay focused on your investment goals and make rational choices based on thorough research and disciplined investing practices. Remember, investing is a journey that requires patience, discipline, and a commitment to your long-term financial objectives. 7.3 Sticking to your investment plan. One of the most crucial aspects of successful investing is the ability to stick to your investment plan. While it may sound simple, many investors struggle with this fundamental principle. They often get swayed by market fluctuations, emotions, and external influences, leading them to deviate from their original strategy. However, staying disciplined and committed to your investment plan is essential for long-term success in the market. 7.3.1 The importance of consistency. Consistency is key when it comes to investing. By sticking to your investment plan, you are ensuring that your decisions are based on a well-thought-out strategy rather than short-term market fluctuations. It helps you avoid making impulsive decisions that can have a negative impact on your portfolio. Consistency also allows you to take advantage of the power of compounding. By staying invested and consistently contributing to your portfolio, you give your investments time to grow and benefit from the compounding effect. Over time, even small contributions can have a significant impact on your overall returns. 7.3.2 Overcoming emotional biases. Emotions can be a significant obstacle when it comes to sticking to your investment plan. Fear and greed are two common emotions that can lead investors astray. During periods of market volatility, fear can drive investors to sell their investments, missing out on potential gains. On the other hand, greed can lead investors to chase after hot trends or take on excessive risks. To overcome these emotional biases, it is essential to have a well-defined investment plan in place. This plan should outline your long-term goals, risk tolerance, and asset allocation strategy. By having a clear roadmap, you can rely on your plan rather than succumbing to emotional impulses. 7.3.3 Avoiding market timing. Market timing is a common pitfall that many investors fall into. It involves trying to predict the short-term movements of the market and making investment decisions based on those predictions. However, research has consistently shown that market timing is extremely difficult, if not impossible, to consistently get right. By sticking to your investment plan, you avoid the temptation to time the market. Instead, you focus on your long-term goals and stay invested for the duration of your investment horizon. This approach allows you to benefit from the long-term growth of the market and avoid the stress and potential losses associated with trying to time short-term market movements. 7.3.4 Revisiting and adjusting your plan. While it is important to stick to your investment plan, it is also essential to periodically review and adjust it as needed. The financial landscape is constantly evolving, and your personal circumstances may change over time. Regularly reassessing your plan ensures that it remains aligned with your goals and risk tolerance. When reviewing your investment plan, consider factors such as your time horizon, financial goals, and any significant life events that may impact your investment strategy. If necessary, make adjustments to your asset allocation, investment vehicles, or contribution amounts to ensure that your plan remains on track. 7.3.5 Seeking professional guidance. Sticking to your investment plan can be challenging, especially during times of market volatility or uncertainty. In such situations, seeking professional guidance can provide valuable support and help you stay on track. A financial advisor or investment manager can offer objective advice and help you navigate through market fluctuations. They can provide a fresh perspective, keep you focused on your long-term goals, and provide reassurance during turbulent times. Working with a professional can also help you avoid making impulsive decisions based on emotions or short-term market trends. 7.3.6 Building discipline and patience. Sticking to your investment plan requires discipline and patience. It is essential to resist the urge to make knee-jerk reactions to market movements or chase after the latest investment fads. Instead, focus on the long term and trust in the soundness of your investment strategy. Building discipline and patience takes time and practice. It involves developing a mindset that is focused on long-term goals rather than short-term gains. It also requires staying informed about your investments in the broader market, so you can make informed decisions based on facts rather than emotions. 7.3.7 The benefits of staying the course. Sticking to your investment plan offers several benefits. Firstly, it helps you avoid costly mistakes that can derail your financial goals. By staying disciplined, you are less likely to make impulsive decisions that can lead to unnecessary losses. Secondly, sticking to your plan allows you to take advantage of the power of compounding. By staying invested and consistently contributing to your portfolio, you give your investments time to grow and benefit from the compounding effect. Lastly, staying the course instills confidence and peace of mind. By having a well-defined investment plan and sticking to it, you can have confidence in your decisions and avoid the stress and anxiety that often accompany market volatility. In conclusion, sticking to your investment plan is crucial for long-term success in the market. It requires consistency, discipline, and the ability to overcome emotional biases. By staying committed to your plan, you can navigate through market fluctuations, take advantage of the power of compounding, and achieve your financial goals. 7.4 Developing discipline in investment practices. Developing discipline in investment practices is crucial for achieving long-term success in the market. It requires a strong commitment to following a set of rules and principles, even in the face of uncertainty and market volatility. Discipline helps investors stay focused on their investment goals and avoid making impulsive decisions that can lead to costly mistakes. 7.4.1 Understanding the importance of discipline. Discipline is the foundation of successful investing. It helps investors stay on track and avoid the common pitfalls that can derail their financial goals. Without discipline, investors may fall prey to emotional decision-making, market timing, and chasing hot tips, which can lead to poor investment performance. Discipline provides a framework for making rational and informed investment decisions. It helps investors stick to their investment plan, regardless of short-term market fluctuations. By maintaining discipline, investors can avoid knee-jerk reactions to market volatility and stay focused on their long-term objectives. 7.4.2 Setting clear investment rules. To develop discipline in investment practices, it is essential to establish clear investment rules. These rules should be based on a well-defined investment strategy and align with the investor's risk tolerance and financial goals. By setting clear rules, investors can avoid making impulsive decisions based on short-term market movements. Investment rules can include guidelines on asset allocation, diversification, risk management, and portfolio rebalancing. For example, an investor may set a rule to allocate a certain percentage of their portfolio to different asset classes, such as stocks, bonds, and cash. They may also establish a rule to rebalance their portfolio annually to maintain the desired asset allocation. By adhering to these rules, investors can avoid making emotional decisions driven by fear or greed. Instead, they can rely on a disciplined approach that is grounded in their investment strategy and long-term objectives. 7.4.3 Creating a routine. Developing discipline in investment practices requires creating a routine that supports consistent and systematic decision-making. This routine can include regular reviews of investment portfolios, analysis of market trends, and monitoring of investment performance. A routine helps investors stay organized and focused on their investment goals. It provides a structured framework for evaluating investment opportunities and making informed decisions. By following a routine, investors can avoid impulsive actions and ensure that their investment decisions are based on thorough analysis and research. 7.4.4 Managing emotions. Emotions can often cloud judgment and lead to irrational investment decisions. Developing discipline in investment practices involves managing emotions effectively. This can be achieved by maintaining a long-term perspective, focusing on the fundamentals of investments, and avoiding reactionary behavior. One way to manage emotions is to establish predetermined exit points for investments. By setting stop-loss orders or profit targets, investors can remove the emotional element from their decision-making process. This allows them to make rational decisions based on predetermined criteria rather than reacting to short-term market fluctuations. Additionally, investors can benefit from seeking support and guidance from a financial advisor or mentor. These professionals can provide an objective perspective and help investors stay disciplined during challenging market conditions. 7.4.5 Learning from mistakes. Developing discipline in investment practices also involves learning from past mistakes. Every investor is bound to make errors at some point, but it is essential to reflect on these mistakes and use them as learning opportunities. By analyzing past mistakes, investors can identify patterns and behaviors that led to poor investment decisions. This self-reflection allows them to make necessary adjustments to their investment approach and avoid repeating the same errors in the future. Furthermore, continual learning and adaptation are crucial for maintaining discipline in investment practices. The investment landscape is constantly evolving, and investors must stay informed about market trends, economic indicators, and new investment opportunities. By staying educated and adaptable, investors can make informed decisions and adjust their strategies as needed. 7.4.6 Seeking accountability. Accountability is a vital aspect of developing discipline in investment practices. Investors can benefit from seeking accountability through various means, such as joining investment clubs, participating in online forums, or partnering with a financial advisor. By surrounding themselves with like-minded individuals who share similar investment goals, investors can hold each other accountable for sticking to their investment plans and maintaining discipline. These communities provide a support system and can offer valuable insights and perspectives. Additionally, working with a financial advisor can provide an external source of accountability. A trusted advisor can help investors stay disciplined by providing objective advice, monitoring investment performance, and offering guidance during challenging market conditions. 7.4.7 Staying committed to long-term goals. Developing discipline in investment practices requires a commitment to long-term goals. It is essential to stay focused on the bigger picture and not get swayed by short-term market fluctuations or external noise. By maintaining a long-term perspective, investors can avoid making impulsive decisions based on fear or greed. They can stay committed to their investment strategy and ride out market volatility with confidence, knowing that their decisions are grounded in thorough research and analysis. 7.4.8 Reviewing and adjusting investment plan. Lastly, developing discipline in investment practices involves regularly reviewing and adjusting the investment plan. As market conditions change and personal circumstances evolve, it is crucial to reassess the investment strategy and make necessary adjustments. By conducting periodic reviews, investors can ensure that their investment plan remains aligned with their financial goals and risk tolerance. This allows them to stay disciplined and make informed decisions based on the most up-to-date information. In conclusion, developing discipline in investment practices is essential for achieving long-term success in the market. It involves setting clear investment rules, creating a routine, managing emotions, learning from mistakes, seeking accountability, staying committed to long-term goals, and regularly reviewing and adjusting the investment plan. By cultivating discipline, investors can navigate the complexities of the market with confidence and increase their chances of achieving their financial objectives. 8. Failing to diversify. 8.1 Understanding the importance of diversification. Diversification is a fundamental principle in investing that aims to reduce risk and maximize returns. It involves spreading your investments across different asset classes, sectors, and geographic regions to create a well-balanced portfolio. By diversifying your investments, you can potentially minimize the impact of any single investment's performance on your overall portfolio. 8.1.1 The benefits of diversification. Diversification is often referred to as the only free lunch in investing because it allows you to achieve a higher level of return for a given level of risk. By investing in a variety of assets, you can potentially reduce the volatility of your portfolio and increase the likelihood of achieving your investment goals. One of the key benefits of diversification is the reduction of unsystematic risk, also known as specific risk or company-specific risk. Unsystematic risk refers to the risk that is specific to a particular company or industry. By spreading your investments across different companies and sectors, you can mitigate the impact of negative events that may affect a single company or industry. For example, if you have all your investments in a single company and that company experiences financial difficulties or faces regulatory issues, your entire investment could be at risk. However, by diversifying your portfolio across multiple companies and sectors, the negative impact of any single company's performance is minimized. Diversification also helps to manage systematic risk, which is the risk that affects the entire market or a particular asset class. While diversification cannot eliminate systematic risk entirely, it can help reduce its impact on your portfolio. By investing in different asset classes, such as stocks, bonds, and real estate, you can potentially offset the losses in one asset class with gains in another. 8.1.2 Common mistakes in portfolio diversification. While diversification is a powerful tool, many investors make common mistakes that can undermine its effectiveness. It is important to be aware of these mistakes and avoid them to ensure that your portfolio is properly diversified. 8.1.2.1 Overconcentration in a single asset or sector. One common mistake is overconcentration in a single asset or sector. Some investors may become overly confident in a particular investment or sector and allocate a significant portion of their portfolio to it. While this strategy can yield high returns if the investment performs well, it also exposes the investor to a higher level of risk. If the investment or sector experiences a downturn, the entire portfolio may suffer significant losses. To avoid this mistake, it is important to diversify across different asset classes and sectors. By spreading your investments across a variety of assets, you can reduce the impact of any single investment's performance on your overall portfolio. 8.1.2.2 Lack of geographic diversification. Another common mistake is the lack of geographic diversification. Investing solely in your home country's market can expose your portfolio to country-specific risks, such as political instability, economic downturns, or regulatory changes. By diversifying your investments across different countries and regions, you can potentially reduce the impact of these risks and take advantage of global opportunities. 8.1.2.3 Neglecting different investment styles. Investors often have different investment styles, such as value investing, growth investing, or income investing. Neglecting to diversify across different investment styles can limit your portfolio's potential for growth. Each investment style performs differently in various market conditions, and by diversifying across different styles, you can potentially benefit from the strengths of each approach. 8.1.2.4 Ignoring asset class diversification. Asset class diversification is another crucial aspect of portfolio diversification. Different asset classes, such as stocks, bonds, real estate, and commodities, have different risk and return characteristics. Ignoring asset class diversification can expose your portfolio to unnecessary risk or limit its potential for growth. By allocating your investments across different asset classes, you can potentially achieve a better risk-return trade-off. 8.1.3 Diversifying across asset classes and sectors. To achieve effective diversification, it is important to spread your investments across different asset classes and sectors. This can be done by investing in a mix of stocks, bonds, real estate, commodities, and other investment vehicles. When diversifying across asset classes, it is important to consider the correlation between different asset classes. Correlation measures the relationship between the returns of two investments. Investments with a high positive correlation tend to move in the same direction, while investments with a negative correlation tend to move in opposite directions. By investing in asset classes with low or negative correlations, you can potentially reduce the overall volatility of your portfolio. Diversifying across sectors involves investing in companies from different industries. This helps to reduce the impact of any single industry's performance on your portfolio. For example, if you have investments in both technology and healthcare sectors, a downturn in the technology sector may be offset by the positive performance of the healthcare sector. 8.1.4 Rebalancing your investment portfolio. Diversification is not a one-time event but an ongoing process. As the market conditions change and the performance of your investments varies, your portfolio's asset allocation may deviate from your desired allocation. Rebalancing your portfolio involves periodically adjusting your investments to maintain your desired asset allocation. Rebalancing typically involves selling investments that have performed well and buying investments that have underperformed. This ensures that your portfolio remains diversified and aligned with your investment goals. By rebalancing regularly, you can potentially capture gains from investments that have performed well and take advantage of opportunities in underperforming assets. In conclusion, diversification is a crucial aspect of successful investing. By spreading your investments across different asset classes, sectors, and geographic regions, you can potentially reduce risk and maximize returns. Avoiding common mistakes in portfolio diversification, such as overconcentration and neglecting different investment styles, is essential to achieve effective diversification. Regularly rebalancing your portfolio helps to maintain your desired asset allocation and adapt to changing market conditions. 8.2 Common mistakes in portfolio diversification. Diversification is a fundamental principle in investing that aims to reduce risk by spreading investments across different asset classes, sectors, and geographic regions. While diversification can help protect investors from significant losses, it is important to understand and avoid common mistakes that can undermine the effectiveness of a diversified portfolio. In this section, we will explore some of these mistakes and provide guidance on how to avoid them. 8.2.1 Overconcentration in a single asset or sector. One of the most common mistakes in portfolio diversification is overconcentration in a single asset or sector. While it may be tempting to invest heavily in a particular stock or industry that is performing well, this approach can expose investors to significant risk. If that asset or sector experiences a downturn, the entire portfolio can suffer. To avoid this mistake, it is crucial to diversify across different asset classes and sectors. By spreading investments across a variety of industries, such as technology, healthcare, finance, and consumer goods, investors can reduce the impact of any single sector's performance on their overall portfolio. Additionally, allocating investments to different asset classes, such as stocks, bonds, and real estate, can further enhance diversification and provide a cushion against market volatility. 8.2.2 Lack of geographic diversification. Another common mistake is neglecting geographic diversification. Investing solely in domestic markets can expose investors to country-specific risks, such as political instability, economic downturns, or regulatory changes. By diversifying globally, investors can mitigate these risks and take advantage of opportunities in different regions. To achieve geographic diversification, investors can consider investing in international stocks, bonds, or exchange-traded funds (ETFs) that provide exposure to various countries and regions. This approach allows investors to benefit from the growth potential of emerging markets while also balancing their portfolio with investments in more established economies. 8.2.3 Failure to rebalance the portfolio. A crucial aspect of portfolio diversification is regularly rebalancing the portfolio. Over time, the performance of different assets within a portfolio can vary, leading to a shift in the portfolio's allocation. If left unaddressed, this can result in an unintended concentration of assets and increased risk. To avoid this mistake, investors should periodically review their portfolio and rebalance it to maintain the desired asset allocation. This involves selling assets that have become overweighted and reinvesting the proceeds into underweighted assets. By rebalancing, investors can ensure that their portfolio remains aligned with their risk tolerance and investment objectives. 8.2.4 Neglecting to consider correlations. Correlation refers to the relationship between the performance of different assets. Assets with a high positive correlation tend to move in the same direction, while assets with a negative correlation move in opposite directions. Neglecting to consider correlations can lead to a false sense of diversification. To effectively diversify a portfolio, investors should consider assets with low or negative correlations. By including assets that have historically exhibited different performance patterns, investors can reduce the overall volatility of their portfolio. This can be achieved by combining assets from different sectors, industries, and geographic regions that have shown low correlation in the past. 8.2.5 Overlooking the impact of fees and expenses. Investors often overlook the impact of fees and expenses on their portfolio's performance. High fees can erode investment returns over time, making it essential to consider the cost of investing when constructing a diversified portfolio. To avoid this mistake, investors should carefully evaluate the fees associated with different investment products, such as mutual funds, ETFs, or managed portfolios. Comparing expense ratios and understanding the potential impact on long-term returns can help investors make informed decisions and select cost-effective investment options. 8.2.6 Failing to monitor and adjust the portfolio. Lastly, failing to monitor and adjust the portfolio regularly can undermine the effectiveness of diversification. Market conditions, economic factors, and individual investment performance can change over time, requiring adjustments to the portfolio to maintain diversification and align with investment goals. Investors should regularly review their portfolio's performance, monitor market trends, and stay informed about changes in the investment landscape. This allows them to identify any imbalances, make necessary adjustments, and take advantage of new investment opportunities. By actively managing their portfolio, investors can ensure that their diversification strategy remains effective and aligned with their long-term objectives. In conclusion, portfolio diversification is a critical component of successful investing. However, it is essential to avoid common mistakes that can undermine the benefits of diversification. By avoiding overconcentration, diversifying geographically, rebalancing regularly, considering correlations, being mindful of fees, and actively monitoring the portfolio, investors can enhance the effectiveness of their diversification strategy and increase their chances of achieving their investment goals. 8.3 Diversifying across asset classes and sectors. Diversification is a fundamental principle of successful investing. It involves spreading your investments across different asset classes and sectors to reduce risk and increase the potential for returns. By diversifying, you can protect your portfolio from the volatility of individual investments and take advantage of opportunities in various areas of the market. 8.3.1 The importance of diversification. Diversification is crucial because it helps to minimize the impact of any single investment on your overall portfolio. When you invest in a variety of asset classes and sectors, you are less exposed to the risk of a significant loss if one investment performs poorly. By spreading your investments, you can potentially offset losses in one area with gains in another. One of the main benefits of diversification is that it can help to smooth out the overall performance of your portfolio. Different asset classes and sectors tend to perform differently under various market conditions. For example, during a period of economic growth, stocks may perform well, while bonds may provide stability during times of market volatility. By holding a mix of investments, you can reduce the impact of market fluctuations on your portfolio. 8.3.2 Common mistakes in portfolio diversification. While diversification is essential, there are common mistakes that investors make when attempting to diversify their portfolios. These mistakes can undermine the effectiveness of diversification and potentially increase risk. It is important to be aware of these pitfalls and avoid them. 1. Overconcentration in a single asset class or sector. One common mistake is overconcentration in a single asset class or sector. This occurs when an investor puts a significant portion of their portfolio into one type of investment, such as stocks or real estate. While it is important to have exposure to different asset classes, relying too heavily on one can expose your portfolio to unnecessary risk. If that particular asset class or sector experiences a downturn, your entire portfolio may suffer. 2. Lack of sufficient diversification. Another mistake is not diversifying enough. Some investors may hold a few different stocks or funds but fail to diversify across different asset classes and sectors. This limited diversification can leave your portfolio vulnerable to market fluctuations. It is important to have a well-rounded mix of investments that includes stocks, bonds, real estate, commodities, and other asset classes. 3. Ignoring correlations. Correlations refer to the relationship between different investments. Some investments may move in the same direction, while others may move in opposite directions. Ignoring correlations can lead to ineffective diversification. For example, if an investor holds multiple stocks in the same industry, they may be exposed to similar risks. It is important to consider how investments within your portfolio interact with each other to achieve true diversification. 4. Failing to rebalance. Rebalancing is the process of adjusting your portfolio periodically to maintain your desired asset allocation. Failing to rebalance can lead to a portfolio that becomes unbalanced over time. For example, if stocks perform well and increase in value, they may come to represent a larger portion of your portfolio than intended. Rebalancing ensures that you maintain your desired level of diversification and risk exposure. 8.3.3 Diversifying across asset classes. To effectively diversify across asset classes, it is important to understand the characteristics and risks associated with each class. Here are some common asset classes and their characteristics. 1. Stocks. Stocks represent ownership in a company and offer the potential for capital appreciation. They tend to be more volatile than other asset classes but also have the potential for higher returns over the long term. Stocks can be further diversified by investing in different sectors, such as technology, healthcare, or consumer goods. 2. Bonds. Bonds are debt securities issued by governments, municipalities, or corporations. They provide regular interest payments and return the principal amount at maturity. Bonds are generally considered less risky than stocks but offer lower potential returns. They can be diversified by investing in bonds with different maturities and credit ratings. 3. Real estate. Real estate investments can include residential, commercial, or industrial properties. Real estate offers the potential for income through rental payments and capital appreciation. Investing in different types of properties and locations can help diversify your real estate holdings. 4. Commodities. Commodities include physical goods such as gold, oil, natural gas, and agricultural products. They can provide a hedge against inflation and diversification benefits. Commodities can be invested indirectly or through commodity futures contracts. 5. Alternative investments. Alternative investments include hedge funds, private equity, venture capital, and other non-traditional assets. These investments can provide diversification benefits and potentially higher returns but often come with higher risks and limited liquidity. 8.3.4 Diversifying across sectors. In addition to diversifying across asset classes, it is important to diversify across sectors within each asset class. Sectors represent different industries or segments of the economy. Here are some common sectors and their characteristics. 1. Technology. The technology sector includes companies involved in the development and production of technology products and services. This sector can offer high growth potential but also carries higher volatility. 2. Healthcare. The healthcare sector includes companies involved in pharmaceuticals, biotechnology, medical devices, and healthcare services. This sector can provide stability and long-term growth potential due to the increasing demand for healthcare services. 3. Financials. The financial sector includes banks, insurance companies, and other financial institutions. This sector can be influenced by economic conditions and regulatory changes. Diversifying across different types of financial companies can help mitigate risks. 4. Consumer goods. The consumer goods sector includes companies that produce and sell products for personal use, such as food, beverages, clothing, and household items. This sector tends to be less volatile and can provide stability to a portfolio. 5. Energy. The energy sector includes companies involved in the production, exploration, and distribution of energy resources. This sector can be influenced by factors such as oil prices and geopolitical events. Diversifying across different energy sources, such as oil, natural gas, and renewable energy, can help manage risks. By diversifying across asset classes and sectors, you can create a well-rounded portfolio that is better positioned to weather market fluctuations and take advantage of opportunities. Remember to regularly review and rebalance your portfolio to maintain your desired level of diversification. 8.4 Rebalancing your investment portfolio. As an investor, it is crucial to understand the importance of regularly rebalancing your investment portfolio. Rebalancing involves adjusting the allocation of your investments to maintain your desired asset allocation and risk level. Over time, the performance of different asset classes can vary, causing your portfolio to deviate from your original investment strategy. By rebalancing, you can bring your portfolio back in line with your goals and objectives. 8.4.1 Why is rebalancing important? Rebalancing is important for several reasons. First, it helps to control risk. When certain asset classes outperform others, they can become a larger portion of your portfolio. This can increase the overall risk of your investments, as you become more exposed to the performance of a single asset class. By rebalancing, you can reduce this concentration risk and ensure that your portfolio remains diversified. Second, rebalancing allows you to take advantage of market opportunities. When certain asset classes underperform, they may become undervalued. By rebalancing, you can sell some of the outperforming assets and buy more of the underperforming assets, potentially benefiting from their future recovery. Third, rebalancing helps you stay disciplined and focused on your long-term investment strategy. It prevents you from making emotional investment decisions based on short-term market fluctuations. Instead, it encourages you to stick to your predetermined asset allocation and investment plan. 8.4.2 When should you rebalance? The frequency of rebalancing depends on your investment strategy and personal preferences. Some investors prefer to rebalance on a set schedule, such as quarterly or annually. Others choose to rebalance when their portfolio deviates from their target allocation by a certain percentage, typically around 5% to 10%. It is important to note that rebalancing too frequently can lead to excessive trading costs and may not be necessary if the deviations are minimal. On the other hand, rebalancing too infrequently can result in a portfolio that is significantly different from your original allocation, potentially exposing you to higher levels of risk. 8.4.3 How to rebalance your portfolio. Rebalancing your portfolio involves several steps. Review your current asset allocation. Start by reviewing your current asset allocation and comparing it to your target allocation. Determine the percentage of each asset class in your portfolio and identify any deviations. Determine the rebalancing strategy. Decide how you will rebalance your portfolio. There are two main approaches: the percentage-based approach and the threshold-based approach. Percentage-based approach. In this approach, you rebalance your portfolio when the percentage of an asset class deviates from your target allocation by a certain percentage. For example, if your target allocation for stocks is 60% and it exceeds 65%, you would sell some stocks and buy other assets to bring it back to 60%. Threshold-based approach. In this approach, you rebalance your portfolio when the deviation from your target allocation exceeds a predetermined threshold. For example, if your target allocation for stocks is 60% and it deviates by more than 5%, you would rebalance. Execute the rebalancing trades. Once you have determined your rebalancing strategy, execute the necessary trades to bring your portfolio back in line with your target allocation. This may involve selling some assets that have performed well and buying assets that have underperformed. Consider tax implications. Before making any trades, consider the tax implications of selling investments. If you hold investments in taxable accounts, selling them may trigger capital gains taxes. Consult with a tax professional to understand the potential tax consequences of rebalancing. Monitor and adjust. After rebalancing, continue to monitor your portfolio regularly. As market conditions change, your asset allocation may drift again. Make adjustments as necessary to maintain your desired allocation. 8.4.4 Benefits of rebalancing. Rebalancing your investment portfolio offers several benefits. Risk control. By rebalancing, you can control the risk in your portfolio and prevent it from becoming too heavily weighted in any one asset class. This helps to protect your investments from excessive volatility and potential losses. Diversification. Rebalancing ensures that your portfolio remains diversified, which is essential for managing risk. It allows you to take advantage of the performance of different asset classes and reduces the impact of any single investment on your overall portfolio. Long-term performance. Rebalancing allows you to buy low and sell high. By selling assets that have performed well and buying assets that have underperformed, you can potentially enhance your long-term investment returns. Discipline and focus. Rebalancing encourages discipline and helps you stay focused on your long-term investment goals. It prevents you from making impulsive investment decisions based on short-term market fluctuations. Peace of mind. Knowing that your portfolio is regularly rebalanced can provide peace of mind. It gives you confidence that you are taking proactive steps to manage risk and optimize your investment strategy. In conclusion, rebalancing your investment portfolio is a critical component of successful investing. It helps control risk, takes advantage of market opportunities, and keeps you disciplined and focused on your long-term goals. By regularly reviewing and adjusting your asset allocation, you can ensure that your portfolio remains aligned with your investment objectives and maximizes your chances of long-term financial success. 9. Neglecting to set clear goals. 9.1 The significance of setting investment goals. Setting clear and well-defined investment goals is a crucial step in achieving financial success in the market. Without a clear direction and purpose, investors may find themselves aimlessly navigating the complex world of investing, making hasty decisions, and ultimately falling short of their desired outcomes. In this section, we will explore the significance of setting investment goals and how they can guide investors towards making informed and strategic investment decisions. 9.1.1 Understanding the purpose of investment goals. Investment goals serve as a roadmap for investors, providing them with a sense of direction and purpose. They help investors define their financial objectives, whether it is to save for retirement, purchase a home, fund a child's education, or achieve financial independence. By setting clear goals, investors can align their investment strategies and decisions with their long-term aspirations. 9.1.2 Avoiding aimless investing. Investing without clear goals is akin to sailing without a destination. Without a specific target in mind, investors may find themselves jumping from one investment opportunity to another, without a coherent strategy or plan. This aimless approach can lead to poor decision-making, excessive risk-taking, and ultimately, subpar investment performance. By setting investment goals, investors can avoid the trap of aimless investing. Goals provide a framework for decision-making, helping investors filter out irrelevant opportunities and focus on investments that align with their objectives. This clarity allows investors to make more informed choices, reducing the likelihood of impulsive and emotionally driven decisions. 9.1.3 Setting realistic and achievable investment targets. While it is important to dream big, setting realistic and achievable investment targets is crucial for long-term success. Unrealistic goals can lead to frustration, disappointment, and a higher likelihood of abandoning the investment journey altogether. It is essential to strike a balance between ambition and feasibility when setting investment targets. Investors should consider their financial situation, risk tolerance, time horizon, and market conditions when setting investment goals. By taking these factors into account, investors can establish targets that are challenging yet attainable. This approach allows for a sense of accomplishment as milestones are reached, motivating investors to stay on track and continue working towards their long-term objectives. 9.1.4 Monitoring and adjusting your investment goals. Investment goals are not set in stone. As circumstances change, it is important for investors to regularly monitor and evaluate their progress towards their goals. This ongoing assessment allows investors to make necessary adjustments to their investment strategies, ensuring that they remain aligned with their evolving financial situation and aspirations. Regular monitoring of investment goals also provides an opportunity for investors to celebrate milestones and acknowledge their progress. This positive reinforcement can help investors stay motivated and committed to their long-term investment plan, even during challenging market conditions. 9.1.5 Aligning investment goals with risk tolerance. Investment goals should be aligned with an investor's risk tolerance. While it is natural to seek higher returns, it is important to understand the level of risk that one is comfortable with. Setting investment goals that are too aggressive may expose investors to unnecessary risk and potential losses. On the other hand, setting goals that are too conservative may limit the potential for growth and wealth accumulation. By understanding their risk tolerance and aligning it with their investment goals, investors can strike a balance between risk and reward. This ensures that their investment strategies are in line with their comfort level, allowing them to navigate the market with confidence and peace of mind. 9.1.6 The power of visualization. Setting investment goals is not just about numbers and figures, it is also about visualization. By clearly visualizing the desired outcomes, investors can create a sense of purpose and motivation. Visualization techniques, such as creating vision boards or writing down specific goals, can help investors stay focused and committed to their investment journey. When investors can vividly imagine the benefits and rewards of achieving their investment goals, it becomes easier to stay disciplined and make informed decisions. Visualization can serve as a powerful tool to overcome short-term temptations and distractions, keeping investors on track towards their long-term financial objectives. 9.1.7 Seeking professional guidance. While setting investment goals is a personal endeavor, seeking professional guidance can provide valuable insights and expertise. Financial advisors and investment professionals can help investors assess their financial situation, define realistic goals, and develop tailored investment strategies to achieve those goals. Working with professionals can also provide investors with a sense of accountability and support. Regular check-ins and reviews with a financial advisor can help investors stay on track, make necessary adjustments, and ensure that their investment goals remain relevant and achievable. In conclusion, setting clear and well-defined investment goals is a fundamental step in avoiding common investor mistakes. By understanding the purpose of investment goals, avoiding aimless investing, setting realistic targets, monitoring progress, aligning goals with risk tolerance, visualizing success, and seeking professional guidance, investors can navigate the market with confidence and increase their chances of achieving long-term financial success. 9.2 Avoiding aimless investing. Investing without clear goals is like setting sail without a destination. Without a clear direction, investors can easily fall into the trap of aimless investing, which can lead to poor decision-making, lack of focus, and ultimately, unsatisfactory results. In this section, we will explore the importance of setting clear investment goals and provide strategies to avoid aimless investing. 9.2.1 The consequences of aimless investing. Aimless investing refers to the act of making investment decisions without a specific purpose or objective in mind. It often occurs when investors fail to define their financial goals, risk tolerance, and time horizon. Without a clear understanding of what they want to achieve, investors may find themselves making impulsive decisions, chasing short-term gains, or succumbing to market noise and trends. One of the main consequences of aimless investing is the lack of focus. Without a clear goal, investors may find themselves jumping from one investment opportunity to another, without fully understanding the risks and potential rewards. This lack of focus can lead to poor portfolio performance and missed opportunities for long-term wealth accumulation. Another consequence of aimless investing is the inability to measure progress. Without clear goals, investors have no benchmarks to evaluate their performance against. This makes it difficult to determine whether their investment strategy is effective or if adjustments need to be made. As a result, investors may find themselves stuck in a cycle of aimless investing, never truly achieving their desired financial outcomes. 9.2.2 Setting clear investment goals. To avoid aimless investing, it is crucial to set clear and specific investment goals. These goals should be based on your financial needs, risk tolerance, and time horizon. Here are some steps to help you define your investment goals. Assess your financial situation. Start by evaluating your current financial position, including your income, expenses, assets, and liabilities. This will give you a clear understanding of your financial needs and help you determine how much you can invest. Define your objectives. Identify what you want to achieve through your investments. Are you saving for retirement, a down payment on a house, or your children's education? Setting specific objectives will provide you with a clear direction and motivation for your investment journey. Determine your risk tolerance. Understand your comfort level with risk and volatility. Consider factors such as your age, financial obligations, and investment experience. This will help you determine the appropriate asset allocation and investment strategies that align with your risk tolerance. Set realistic and achievable targets. Your investment goals should be realistic and attainable within a given time frame. Avoid setting overly ambitious targets that may lead to frustration or excessive risk-taking. Break down your long-term goals into smaller milestones to track your progress along the way. 9.2.3 Creating a strategic investment plan. Once you have defined your investment goals, it is essential to develop a strategic investment plan to guide your decision-making process. A well-designed plan will provide you with a roadmap to achieve your objectives and help you avoid aimless investing. Here are some key elements to consider when creating your plan. Asset allocation. Determine the appropriate mix of asset classes that align with your risk tolerance and investment goals. This involves diversifying your portfolio across different asset classes, such as stocks, bonds, real estate, and cash equivalents. Investment strategy. Choose an investment strategy that suits your goals and risk tolerance. This could include strategies such as value investing, growth investing, or income investing. Consider factors such as your time horizon, investment knowledge, and comfort with active or passive management. Regular monitoring and review. Regularly review your investment portfolio to ensure it remains aligned with your goals and risk tolerance. Monitor the performance of your investments, make adjustments as needed, and stay informed about market trends and economic conditions that may impact your portfolio. Seek professional advice if needed. If you are unsure about creating an investment plan or managing your portfolio, consider seeking professional advice from a financial advisor or investment manager. They can provide guidance based on their expertise and help you navigate the complexities of the financial markets. 9.2.4 Staying committed to your investment goals. Avoiding aimless investing requires discipline and commitment to your investment goals. Here are some strategies to help you stay on track. Stay focused. Remind yourself of your investment goals regularly. Keep them visible and review them periodically to stay motivated and focused on the long term. Avoid impulsive decisions. Resist the temptation to make impulsive investment decisions based on short-term market fluctuations or hot tips. Stick to your investment plan and avoid chasing quick gains. Stay informed. Stay updated on market trends, economic news, and changes in the investment landscape. However, be cautious of information overload and focus on reliable sources of information. Regularly review and adjust. Periodically review your investment portfolio to ensure it remains aligned with your goals. Make adjustments as needed, but avoid making frequent changes based on short-term market movements. By setting clear investment goals and creating a strategic investment plan, you can avoid aimless investing and increase your chances of achieving long-term financial success. Remember, investing is a journey, and having a clear destination in mind will help you navigate the ups and downs of the market with confidence and purpose. 9.3 Setting realistic and achievable investment targets. Setting clear and achievable investment targets is a crucial aspect of successful investing. Without well-defined goals, investors may find themselves aimlessly navigating the market, making impulsive decisions, and ultimately falling short of their desired outcomes. In this section, we will explore the importance of setting realistic investment targets and provide guidance on how to establish goals that align with your financial aspirations. 9.3.1 The significance of setting investment goals. Setting investment goals serves as a roadmap for your financial journey. It provides direction, purpose, and a framework for making informed decisions. Without clear goals, investors may find themselves susceptible to emotional decision-making, chasing short-term gains, or succumbing to market noise. By establishing investment goals, you create a benchmark against which you can measure your progress. It allows you to track your performance, evaluate the effectiveness of your strategies, and make necessary adjustments along the way. Moreover, having well-defined goals helps you stay focused and disciplined, even during periods of market volatility or uncertainty. 9.3.2 Avoiding aimless investing. Aimless investing, also known as going with the flow, can lead to haphazard decision-making and suboptimal outcomes. Without specific targets, investors may find themselves jumping from one investment opportunity to another without a clear understanding of their purpose or potential risks. Aimless investing often stems from a lack of clarity about one's financial objectives. It can result in a scattered portfolio, excessive trading, and missed opportunities for long-term growth. By setting investment targets, you can avoid aimless investing and ensure that every decision you make aligns with your overall financial plan. 9.3.3 Setting realistic and achievable investment targets. When setting investment targets, it is essential to be both realistic and achievable. Unrealistic goals can lead to frustration, disappointment, and potentially risky investment strategies. On the other hand, setting achievable targets allows you to maintain a sense of progress and motivation as you work towards your financial aspirations. To set realistic and achievable investment targets, consider the following factors. 1. Time horizon. Your time horizon refers to the length of time you plan to invest before needing to access your funds. It is a critical factor in determining the feasibility of your investment targets. Short-term goals, such as saving for a down payment on a house, may require more conservative investment strategies. In contrast, long-term goals, such as retirement planning, may allow for a more aggressive approach. 2. Risk tolerance. Understanding your risk tolerance is crucial when setting investment targets. Your risk tolerance reflects your comfort level with potential fluctuations in the value of your investments. If you have a low risk tolerance, you may opt for more conservative investments with lower potential returns. Conversely, if you have a higher risk tolerance, you may be willing to accept greater volatility in pursuit of higher potential gains. 3. Financial capacity. Consider your current financial situation and resources when setting investment targets. Assess your income, expenses, and existing assets to determine how much you can comfortably allocate towards your investment goals. Setting targets that are within your financial capacity ensures that you can maintain your lifestyle and meet your financial obligations while working towards your objectives. 4. Market conditions. Take into account the prevailing market conditions when setting investment targets. While it is impossible to predict market movements with certainty, understanding the current economic landscape can help you set realistic expectations. During periods of economic growth, higher returns may be more attainable. Conversely, during economic downturns, it may be prudent to adjust your targets to reflect the potential challenges and uncertainties. 9.3.4 Monitoring and adjusting your investment goals. Once you have established your investment targets, it is essential to regularly monitor your progress and make adjustments as needed. The financial landscape is dynamic, and circumstances may change over time. By regularly reviewing your goals, you can ensure that they remain relevant and aligned with your evolving financial situation. Monitoring your investment goals involves tracking your portfolio performance, evaluating the effectiveness of your strategies, and assessing whether you are on track to achieve your targets. If you find that your goals are no longer realistic or achievable, it may be necessary to make adjustments. This could involve revising your time horizon, reassessing your risk tolerance, or modifying your financial capacity. Remember that setting investment targets is not a one-time event. It is an ongoing process that requires periodic evaluation and adjustment. By staying proactive and adaptable, you can ensure that your investment goals remain relevant and attainable throughout your financial journey. In conclusion, setting realistic and achievable investment targets is crucial for successful investing. It provides direction, focus, and a framework for making informed decisions. By considering factors such as time horizon, risk tolerance, financial capacity, and market conditions, you can establish goals that align with your financial aspirations. Regularly monitoring and adjusting your investment goals ensures that they remain relevant and adaptable to your evolving financial situation. 9.4 Monitoring and adjusting your investment goals. Once you have set your investment goals, it is crucial to regularly monitor and adjust them to ensure that you stay on track and make progress towards achieving them. Monitoring and adjusting your investment goals allows you to stay informed about the performance of your investments and make necessary changes to align them with your evolving financial situation and objectives. 9.4.1 Tracking the performance of your investments. To effectively monitor your investment goals, you need to track the performance of your investments regularly. This involves reviewing the returns, growth, and overall performance of your investment portfolio. By keeping a close eye on your investments, you can identify any underperforming assets or areas that require attention. There are several ways to track the performance of your investments. One common method is to use an investment tracking tool or software that provides real-time updates on the value and performance of your portfolio. These tools often allow you to input your investment holdings and track their performance against various benchmarks or indices. Another approach is to review your investment statements and account summaries regularly. These documents provide a snapshot of your investment performance, including the value of your holdings, any gains or losses, and any fees or expenses incurred. By analyzing these statements, you can gain insights into the performance of your investments and identify any areas that need adjustment. 9.4.2 Evaluating progress towards your investment goals. Monitoring your investment goals also involves evaluating your progress towards achieving them. This requires comparing your current investment performance with the targets you set initially. By assessing your progress, you can determine whether you are on track, falling behind, or exceeding your expectations. When evaluating your progress, consider both the quantitative and qualitative aspects of your investment goals. Quantitative factors include the financial metrics and benchmarks you set, such as a specific rate of return or a target portfolio value. Qualitative factors, on the other hand, involve assessing the alignment of your investments with your broader financial objectives and risk tolerance. Regularly evaluating your progress allows you to identify any gaps or areas for improvement. If you are falling behind your targets, you can explore strategies to boost your investment returns or adjust your asset allocation to align with your goals. Conversely, if you are exceeding your expectations, you may consider rebalancing your portfolio or setting new, more ambitious goals. 9.4.3 Adjusting your investment goals. As your financial situation and objectives evolve, it is essential to adjust your investment goals accordingly. Life events such as marriage, starting a family, changing careers, or nearing retirement can significantly impact your financial needs and risk tolerance. By regularly reassessing your investment goals, you can ensure that they remain relevant and aligned with your changing circumstances. When adjusting your investment goals, consider the following factors. 9.4.3.1 Financial situation. Evaluate your current financial situation, including your income, expenses, and any outstanding debts. Assess whether your investment goals are still realistic and achievable based on your financial resources. If necessary, adjust your goals to ensure they are in line with your financial capacity. 9.4.3.2 Time horizon. Consider the time horizon for your investments. If you have a longer time horizon, you may have more flexibility to pursue higher risk investments with the potential for greater returns. Conversely, if your time horizon is shorter, you may need to adjust your goals to focus on more conservative investments that prioritize capital preservation. 9.4.3.3 Risk tolerance. Evaluate your risk tolerance and comfort level with market volatility. If you find that you are more risk-averse than initially anticipated, you may need to adjust your investment goals to prioritize stability and lower risk assets. On the other hand, if you are comfortable with higher levels of risk, you may consider adjusting your goals to include more aggressive investment strategies. 9.4.3.4 Market Conditions. Take into account the prevailing market conditions and economic outlook. Market fluctuations and changes in the investment landscape can impact the feasibility of your goals. If market conditions are unfavorable or uncertain, you may need to adjust your goals to reflect a more conservative approach or explore alternative investment opportunities. 9.4.4 Seeking professional guidance. Monitoring and adjusting your investment goals can be a complex task, especially if you lack the necessary expertise or time. In such cases, seeking professional guidance from a financial advisor or investment manager can be invaluable. These professionals can provide objective insights, help you evaluate your progress, and assist in making informed adjustments to your investment goals. When choosing a financial advisor or investment manager, consider their qualifications, experience, and track record. Look for professionals who have a deep understanding of your investment objectives and can provide personalized advice tailored to your needs. Regular consultations with a trusted advisor can help ensure that your investment goals remain aligned with your financial aspirations. Conclusion. Monitoring and adjusting your investment goals is a critical aspect of successful investing. By regularly tracking the performance of your investments, evaluating your progress, and making necessary adjustments, you can stay on course towards achieving your financial objectives. Remember to consider your financial situation, time horizon, risk tolerance, and market conditions when adjusting your goals. Seeking professional guidance can also provide valuable insights and support throughout your investment journey. 10. Failing to learn from past mistakes. 10.1 The importance of learning from investment failures. Learning from our mistakes is a fundamental aspect of personal and professional growth. In the world of investing, this principle holds true as well. Every investor, regardless of their experience or expertise, is bound to make mistakes at some point in their journey. However, what sets successful investors apart is their ability to learn from these failures and use them as stepping stones towards future success. 10.1.1 Embracing failure as a learning opportunity. Investing is inherently risky, and no investor is immune to making mistakes. Whether it's a poor investment decision, a missed opportunity, or a misjudgment of market trends, failures are an inevitable part of the investment process. Instead of dwelling on these failures or letting them discourage you, it is crucial to embrace them as valuable learning opportunities. By analyzing and reflecting on our investment failures, we can gain valuable insights into our decision-making process, identify areas for improvement, and refine our investment strategies. Each failure provides a chance to learn more about ourselves as investors and to develop a deeper understanding of the market dynamics. 10.1.2 Identifying the root causes of mistakes. To effectively learn from investment failures, it is essential to identify the root causes of these mistakes. This requires a thorough examination of the factors that contributed to the failure, such as lack of research and due diligence. One common cause of investment failures is a lack of proper research and due diligence. Failing to thoroughly analyze an investment opportunity, understand its underlying fundamentals, and assess its potential risks can lead to poor investment decisions. By recognizing this as a contributing factor, investors can prioritize research and due diligence in their future investment endeavors. Emotional biases and impulsive decision-making. Emotions play a significant role in investment decisions, often leading to biased judgments and impulsive actions. Greed, fear, and overconfidence can cloud an investor's judgment and result in poor investment choices. By acknowledging these emotional biases and developing strategies to manage them, investors can make more rational and informed decisions. Over-reliance on hot tips and trends. Chasing hot tips and trends is another common mistake that can lead to investment failures. Relying solely on the advice of others or following the latest investment fads without conducting proper research can be detrimental to long-term investment success. Recognizing the dangers of this behavior can help investors avoid falling into the trap of chasing short-term gains. Lack of risk management. Neglecting risk management is a critical mistake that can expose investors to unnecessary losses. Failing to implement risk management strategies, such as setting stop-loss orders or diversifying the investment portfolio, can leave investors vulnerable to market volatility and unexpected events. Understanding the importance of risk management and incorporating it into investment practices is crucial for long-term success. 10.1.3 Implementing changes for improvement. Learning from investment failures is not enough on its own, it is equally important to implement changes based on these lessons. Here are some steps investors can take to improve their investment practices. Review and reflect on past mistakes. Take the time to review and reflect on past investment failures. Analyze the factors that contributed to these failures and identify patterns or recurring mistakes. This self-reflection will help you gain a deeper understanding of your investment approach and highlight areas that require improvement. Adjust investment strategies. Based on the insights gained from past failures, make necessary adjustments to your investment strategies. This may involve refining your research process, setting clearer investment goals, or diversifying your portfolio. By adapting your strategies, you can mitigate the risk of repeating past mistakes and increase your chances of success. Seek knowledge and education. Continual learning is a vital aspect of successful investing. Invest in your knowledge by reading books, attending seminars, or taking courses on investment strategies, financial analysis, and market trends. By staying informed and up to date, you can make more informed investment decisions and avoid common pitfalls. Seek guidance from professionals. Consider seeking guidance from professionals, such as financial advisors or investment managers. These experts can provide valuable insights, help you navigate complex investment landscapes, and offer objective advice. Collaborating with professionals can enhance your investment practices and increase your chances of achieving your financial goals. 10.1.4 The Journey of Continuous Improvement. Investing is a journey of continuous improvement, and learning from investment failures is an integral part of this process. By embracing failures as learning opportunities, identifying the root causes of mistakes, implementing changes for improvement, and seeking knowledge and guidance, investors can enhance their investment practices and increase their chances of long-term success. Remember, no investor is immune to mistakes, but it is how we learn from and adapt to these mistakes that ultimately determines our success in the market. So, embrace failure, reflect on your past mistakes, and use them as stepping stones towards becoming a more knowledgeable and successful investor. 10.2 Analyzing and reflecting on past mistakes. As an investor, it is crucial to learn from your mistakes in order to improve your investment practices and achieve long-term success. Analyzing and reflecting on past mistakes allows you to identify areas of weakness, understand the reasons behind those mistakes, and implement changes to avoid repeating them in the future. In this section, we will explore the importance of analyzing and reflecting on past mistakes and provide strategies to help you learn from them. 10.2.1 The benefits of analyzing past mistakes. Analyzing past mistakes is an essential part of the learning process for investors. It provides valuable insights into your decision-making process, highlights areas where you may have gone wrong, and helps you develop a more informed and disciplined approach to investing. Here are some key benefits of analyzing past mistakes. 1. Identifying patterns and trends. By analyzing your past mistakes, you can identify patterns and trends in your investment decisions. This can help you recognize recurring errors or biases that may be hindering your success. For example, you may discover that you tend to make impulsive investment decisions based on short-term market fluctuations. Recognizing this pattern allows you to develop strategies to overcome it and make more rational and informed investment choices. 2. Understanding the reasons behind mistakes. Analyzing past mistakes allows you to delve deeper into the reasons behind those mistakes. It helps you understand the factors that influenced your decision-making process, such as emotions, cognitive biases, or lack of research. By gaining a better understanding of these underlying causes, you can take steps to address them and make more rational investment decisions in the future. 3. Learning from experience. Experience is a valuable teacher, and analyzing past mistakes helps you learn from your own experiences. It provides you with real-life examples of what works and what doesn't in the investment world. By reflecting on your mistakes, you can extract valuable lessons that can guide your future investment decisions. This learning process helps you become a more knowledgeable and skilled investor over time. 4. Building resilience and confidence. Analyzing past mistakes can help you build resilience and confidence in your investment abilities. It allows you to acknowledge that mistakes are a natural part of the learning process and that even experienced investors make them. By learning from your mistakes and implementing changes, you can develop a sense of resilience and confidence in your ability to navigate the ups and downs of the market. 10.2.2 Strategies for analyzing and reflecting on past mistakes. Now that we understand the importance of analyzing and reflecting on past mistakes, let's explore some strategies to help you effectively learn from them. 1. Keep a detailed investment journal. Keeping a detailed investment journal is an excellent way to track your investment decisions and reflect on their outcomes. In your journal, record the rationale behind each investment, the research conducted, and the emotions or biases that may have influenced your decision. After some time has passed, review your journal entries and analyze the outcomes of your investments. This will help you identify any recurring mistakes or patterns and make adjustments to your investment approach. 2. Seek feedback from others. Seeking feedback from trusted individuals, such as mentors or fellow investors, can provide valuable insights into your investment decisions. They can offer a different perspective and help you identify blind spots or areas for improvement. Engaging in discussions or joining investment groups can also expose you to different investment strategies and perspectives, further enhancing your learning process. 3. Conduct post-mortem analysis. After a significant investment decision or trade, conduct a post-mortem analysis to evaluate the outcome and identify any mistakes or areas for improvement. Ask yourself questions such as, what went wrong? What could I have done differently? Did I follow my investment plan? By critically assessing your decisions, you can gain a deeper understanding of your strengths and weaknesses as an investor. 4. Learn from successful investors. Studying the investment strategies and philosophies of successful investors can provide valuable insights into avoiding common mistakes. Read books, articles, and interviews of renowned investors to understand their approaches and learn from their experiences. By studying their successes and failures, you can gain valuable knowledge that can inform your own investment practices. 10.2.3 Implementing changes for future success. Analyzing and reflecting on past mistakes is only valuable if you implement changes to improve your investment practices. Here are some steps you can take to ensure future success. 1. Develop a learning mindset. Approach investing with a learning mindset, recognizing that mistakes are opportunities for growth and improvement. Embrace the idea that investing is a continuous learning process, and each mistake is a chance to refine your skills and knowledge. 2. Set clear investment goals. Setting clear investment goals helps you stay focused and disciplined. Define your short-term and long-term objectives, and align your investment decisions with these goals. Regularly review and adjust your goals as needed to ensure they remain realistic and achievable. 3. Follow a disciplined investment plan. Create a well-defined investment plan that outlines your investment strategy, risk tolerance, and asset allocation. Stick to your plan even during market fluctuations or emotional moments. A disciplined approach helps you avoid impulsive decisions and stay on track towards your investment goals. 4. Continually educate yourself. Investing is a dynamic field, and staying updated with market trends, economic indicators, and investment strategies is crucial. Continually educate yourself through books, courses, seminars, and reputable financial news sources. This ongoing learning process will help you make more informed investment decisions and avoid repeating past mistakes. By analyzing and reflecting on past mistakes, you can transform them into valuable learning experiences. Implementing changes based on these insights will help you become a more knowledgeable, disciplined, and successful investor. Remember, investing is a journey, and learning from your mistakes is an integral part of that journey. 10.3 Implementing changes to improve investment practices. In order to become a successful investor, it is crucial to learn from past mistakes and implement changes to improve your investment practices. This chapter will guide you through the process of identifying areas for improvement and making the necessary adjustments to enhance your investment strategy. 10.3.1 Reflecting on past mistakes. Before you can implement changes, it is important to take the time to reflect on your past investment mistakes. This involves analyzing the decisions you made, understanding the factors that influence those decisions, and identifying the consequences of those choices. By reflecting on your mistakes, you can gain valuable insights into your investment behavior and identify patterns or recurring errors. One effective way to reflect on your past mistakes is to keep a journal or record of your investment decisions. Write down the rationale behind each investment, the outcome, and any lessons learned. This will help you identify patterns and recurring mistakes that you can work on improving. 10.3.2 Identifying areas for improvement. Once you have reflected on your past mistakes, it is time to identify the specific areas where you need to make improvements. This could include areas such as research and due diligence, risk management, decision-making process, or emotional control. By pinpointing the areas that need improvement, you can focus your efforts on making targeted changes. One effective way to identify areas for improvement is to seek feedback from others. This could be from a mentor, a financial advisor, or even fellow investors. They can provide valuable insights and perspectives that you may have overlooked. Additionally, you can also analyze your investment performance and identify any consistent underperforming areas. 10.3.3 Setting clear goals and objectives. One of the key changes you can make to improve your investment practices is to set clear goals and objectives. Without clear goals, it is easy to get swayed by short-term market fluctuations or succumb to impulsive decision-making. By setting specific, measurable, achievable, relevant, and time-bound, SMART goals, you can stay focused and make more informed investment decisions. When setting your investment goals, consider factors such as your risk tolerance, time horizon, and financial objectives. Are you investing for retirement, education, or wealth accumulation? By aligning your goals with your personal circumstances, you can make more strategic investment decisions. 10.3.4 Developing a disciplined investment strategy. Implementing a disciplined investment strategy is another crucial change you can make to improve your investment practices. This involves creating a set of rules and guidelines that govern your investment decisions and sticking to them consistently. A disciplined approach helps to reduce emotional biases and impulsive decision-making. One aspect of a disciplined investment strategy is creating an investment plan. This plan should outline your investment goals, asset allocation strategy, risk tolerance, and criteria for buying and selling investments. By having a well-defined plan, you can avoid making hasty decisions based on short-term market fluctuations. 10.3.5 Embracing continuous learning and adaptation. The investment landscape is constantly evolving, and it is important to stay updated and adapt to changing market conditions. Embracing continuous learning is a key change you can make to improve your investment practices. This involves staying informed about market trends, economic indicators, and industry developments. There are various ways to continue learning as an investor. You can read books, attend seminars or webinars, follow reputable financial news sources, and engage in discussions with other investors. By staying informed and continuously learning, you can make more informed investment decisions and adapt your strategy as needed. 10.3.6 Seeking professional advice. Another change you can make to improve your investment practices is to seek professional advice. While it is important to take ownership of your investments, working with a financial advisor or investment manager can provide valuable expertise and guidance. They can help you navigate complex investment decisions, provide objective insights, and offer personalized recommendations based on your goals and risk tolerance. When seeking professional advice, it is important to choose the right financial advisor or investment manager. Look for professionals who are experienced, knowledgeable, and have a track record of success. Additionally, ensure that their investment philosophy aligns with your own and that they prioritize your best interests. 10.3.7 Monitoring and evaluating your progress. Implementing changes to improve your investment practices is an ongoing process. It is important to regularly monitor and evaluate your progress to ensure that you are on track towards your goals. This involves reviewing your investment performance, assessing the effectiveness of the changes you have made, and making adjustments as necessary. Regularly reviewing your investment portfolio and performance allows you to identify any underperforming investments or areas that require further improvement. It also provides an opportunity to celebrate your successes and acknowledge the positive changes you have made. Conclusion. Implementing changes to improve your investment practices is essential for long-term success in the market. By reflecting on past mistakes, identifying areas for improvement, setting clear goals, developing a disciplined strategy, embracing continuous learning, seeking professional advice, and monitoring your progress, you can enhance your investment approach and increase your chances of achieving your financial objectives. Remember, investing is a journey, and continuous improvement is key to navigating the ever-changing landscape of the market. 10.4 Continual learning and adaptation in investing. Investing in the financial markets is a dynamic and ever-changing endeavor. The landscape of the market is constantly evolving, influenced by various factors such as economic conditions, technological advancements, and geopolitical events. As an investor, it is crucial to recognize the importance of continual learning and adaptation in order to navigate these changes successfully. 10.4.1 Embracing a growth mindset. One of the key aspects of continual learning and adaptation in investing is the development of a growth mindset. This mindset is characterized by a belief that intelligence and abilities can be developed through dedication and hard work. By adopting a growth mindset, investors are more likely to embrace challenges, persist in the face of setbacks, and see failures as opportunities for learning and improvement. In the context of investing, a growth mindset encourages investors to seek out new knowledge, explore different investment strategies, and adapt their approach based on market conditions. It allows investors to view mistakes as valuable learning experiences rather than as failures, enabling them to grow and evolve as investors. 10.4.2 Staying informed and up to date. Continual learning in investing involves staying informed and up to date with the latest developments in the financial markets. This includes keeping track of economic indicators, industry trends, and company news that may impact investment decisions. Investors can achieve this by regularly reading financial news, following reputable sources, and attending investment conferences or seminars. In addition to staying informed about the broader market, investors should also focus on deepening their understanding of specific investment strategies, asset classes, and financial instruments. This can be done through reading books, taking online courses, or seeking guidance from experienced investors or financial professionals. By expanding their knowledge base, investors can make more informed decisions and adapt their strategies to changing market conditions. 10.4.3 Analyzing and reflecting on investment performance. Continual learning in investing also involves analyzing and reflecting on past investment performance. By reviewing their investment decisions and outcomes, investors can identify patterns, strengths, and weaknesses in their approach. This self-reflection allows investors to learn from their mistakes, capitalize on their successes, and make adjustments to their investment strategies. Investors can analyze their investment performance by reviewing their portfolio returns, comparing them to relevant benchmarks, and assessing the impact of their investment decisions on overall performance. They can also evaluate the effectiveness of their risk management strategies, diversification efforts, and asset allocation decisions. Through this analysis, investors can gain valuable insights into their investment approach and make necessary adjustments to improve their future performance. 10.4.4 Seeking feedback and collaboration. Continual learning in investing can be enhanced by seeking feedback and collaborating with other investors or financial professionals. By engaging in discussions and sharing experiences with like-minded individuals, investors can gain different perspectives, challenge their own assumptions, and learn from the experiences of others. Investors can seek feedback by joining investment clubs or online communities, attending investment workshops or seminars, or participating in mentorship programs. These interactions provide opportunities for investors to receive constructive criticism, exchange ideas, and learn from the successes and failures of others. Collaboration with professionals, such as financial advisors or investment managers, can also provide valuable insights and guidance in navigating the complexities of the market. 10.4.5 Adapting to changing market conditions. Adaptation is a crucial aspect of continual learning in investing. The financial markets are dynamic, and what may have worked in the past may not necessarily be effective in the future. Investors need to be flexible and willing to adapt their investment strategies to changing market conditions. This adaptation may involve adjusting asset allocations, exploring new investment opportunities, or even changing investment styles. For example, during periods of economic uncertainty, investors may choose to allocate more funds to defensive assets such as bonds or cash. In contrast, during periods of economic growth, investors may opt for a more aggressive approach by investing in growth-oriented stocks or sectors. By continually assessing market conditions, monitoring economic indicators, and staying informed about emerging trends, investors can make informed decisions and adapt their strategies accordingly. This ability to adapt is crucial in maximizing investment returns and minimizing potential losses. 10.4.6 Implementing a continuous improvement process. Continual learning and adaptation in investing can be facilitated by implementing a continuous improvement process. This involves setting goals, tracking progress, and making adjustments based on feedback and analysis. Investors can set specific goals for their investment performance, risk management, or knowledge acquisition. These goals can be short-term or long-term, and they should be measurable and realistic. By tracking their progress towards these goals, investors can identify areas for improvement and make necessary adjustments to their investment strategies. Regularly reviewing and updating investment plans is also an important part of the continuous improvement process. As market conditions change and new information becomes available, investors should reassess their investment objectives, risk tolerance, and asset allocation. This ensures that their investment strategies remain aligned with their goals and adapt to the evolving market environment. 10.4.7 Conclusion. Continual learning and adaptation are essential for investors to navigate the complexities of the financial markets successfully. By embracing a growth mindset, staying informed, analyzing past performance, seeking feedback, adapting to changing market conditions, and implementing a continuous improvement process, investors can enhance their investment skills and increase their chances of achieving long-term success. Remember, investing is a journey that requires ongoing education, self-reflection, and the willingness to adapt. By committing to continual learning and adaptation, investors can position themselves to make informed decisions, mitigate risks, and capitalize on opportunities in the ever-changing world of investing. 11. Ignoring the power of compounding. 11.1 Understanding the concept of compound interest. Compound interest is a powerful force that can significantly impact your investments over time. It is the concept of earning interest on both the initial amount of money invested, known as the principal, and the accumulated interest from previous periods. In simple terms, compound interest allows your investments to grow exponentially, as the interest earned is reinvested and generates additional interest. 11.1.1 The power of compound interest. The power of compound interest lies in its ability to generate wealth over the long term. By reinvesting the interest earned, your investments can grow at an accelerating rate. This compounding effect can lead to substantial returns, especially when combined with a long-term investment horizon. To illustrate the power of compound interest, let's consider an example. Suppose you invest $10,000 in a savings account with an annual interest rate of 5%. At the end of the first year, you would earn $500 in interest, bringing your total balance to $10,500. In the second year, you would earn interest not only on your initial $10,000 but also on the additional $500 earned in the first year. Assuming the interest rate remains the same, you would earn $525 in the second year, bringing your total balance to $11,025. Over time, the interest earned continues to compound, resulting in exponential growth. 11.1.2 The benefits of starting early and investing regularly. One of the key advantages of compound interest is the benefit of starting early. The earlier you begin investing, the more time your investments have to compound and grow. Even small amounts invested regularly can accumulate into significant sums over time. Let's consider two individuals, Alex and Ben, who both want to save for retirement. Alex starts investing $500 per month at the age of 25 and continues until the age of 35, contributing a total of $60,000. Ben, on the other hand, starts investing the same amount at the age of 35 and continues until the age of 65, contributing a total of $180,000. Assuming an average annual return of 7%, Alex's investments would grow to approximately $1,006,000 by the time he reaches 65. In contrast, Ben's investments would only grow to around $540,000. Despite contributing 3 times the amount, Ben's investments are significantly lower due to the shorter time period for compounding. This example highlights the importance of starting early and investing regularly. By giving your investments more time to compound, you can harness the full potential of compound interest and significantly increase your wealth. 11.1.3 Maximizing the power of compounding in your investments. To maximize the power of compound interest in your investments, there are several strategies you can employ. Start early. As mentioned earlier, the earlier you start investing, the more time your investments have to compound. Even small amounts invested regularly can make a significant difference over the long term. Reinvest dividends and interest. Instead of withdrawing the dividends and interest earned from your investments, consider reinvesting them. By reinvesting, you allow the compounding effect to work its magic and accelerate the growth of your investments. Increase contributions. If possible, increase the amount you contribute to your investments over time. By increasing your contributions, you not only increase the principal amount but also provide more funds for compounding. Take advantage of tax-advantaged accounts. Utilize tax-advantaged accounts such as individual retirement accounts, IRAs, or 401k plans. These accounts offer tax benefits that can enhance the growth of your investments. Stay invested for the long term. Compound interest works best over extended periods. Avoid the temptation to constantly buy and sell investments, as this can disrupt the compounding process. Instead, adopt a long-term investment strategy and stay invested to reap the full benefits of compound interest. 11.1.4 Long-term investing strategies for wealth accumulation. To harness the power of compound interest for long-term wealth accumulation, it is essential to adopt a sound investment strategy. Here are a few strategies to consider. Diversify your portfolio. Spread your investments across different asset classes, sectors, and geographic regions. Diversification helps reduce risk and increases the likelihood of capturing long-term growth opportunities. Invest in quality companies. Focus on investing in well-established companies with strong fundamentals and a track record of consistent growth. These companies are more likely to generate sustainable returns over the long term. Dollar cost averaging. Invest a fixed amount of money at regular intervals, regardless of market conditions. This strategy allows you to buy more shares when prices are low and fewer shares when prices are high, effectively reducing the impact of market volatility. Rebalance regularly. Periodically review and rebalance your investment portfolio to maintain your desired asset allocation. Rebalancing ensures that your investments align with your long-term goals and risk tolerance. Stay informed. Stay updated on market trends, economic indicators, and company news. This knowledge will help you make informed investment decisions and adjust your strategy as needed. By understanding and harnessing the power of compound interest, you can set yourself on a path to long-term wealth accumulation. Remember, the key is to start early, invest regularly, and stay disciplined in your investment approach. 11.2 The benefits of starting early and investing regularly. Investing is a powerful tool for building wealth and achieving financial goals. However, one of the most common mistakes investors make is not starting early enough or investing regularly. Many people underestimate the impact that time and consistency can have on their investment returns. In this section, we will explore the benefits of starting early and investing regularly, and how it can significantly enhance your financial future. 11.2.1 The power of time. Time is a crucial factor when it comes to investing. The earlier you start investing, the more time your money has to grow and compound. Compound interest is the concept of earning interest on both the initial investment and the accumulated interest over time. It is often referred to as the eighth wonder of the world, because of its remarkable ability to multiply wealth. Starting early allows you to take full advantage of the power of compounding. Even small amounts invested regularly can grow into substantial sums over time. The longer your money is invested, the more it can benefit from compounding, and the greater your potential returns will be. 11.2.2 Building wealth gradually. Investing regularly, also known as dollar cost averaging, is another essential strategy for long-term wealth accumulation. By investing a fixed amount of money at regular intervals, regardless of market conditions, you can take advantage of both market highs and lows. When you invest regularly, you buy more shares when prices are low and fewer shares when prices are high. This approach helps to average out the cost of your investments over time, reducing the impact of short-term market fluctuations. It also eliminates the need to time the market, which is a risky and often unsuccessful strategy. Investing regularly allows you to build wealth gradually and consistently. It helps to smooth out the volatility of the market and reduces the risk of making poor investment decisions based on short-term market movements. By investing a fixed amount regularly, you are more likely to stay invested during market downturns and benefit from the eventual recovery. 11.2.3 The benefits of starting early. Starting early has several advantages when it comes to investing. Firstly, it allows you to take advantage of the power of compounding over a more extended period. The longer your money is invested, the more time it has to grow and multiply. Even small amounts invested early on can have a significant impact on your wealth in the long run. Secondly, starting early gives you the opportunity to learn from your investment experiences and make adjustments along the way. Investing is a skill that improves with practice and experience. By starting early, you can gain valuable insights into the market, develop a better understanding of your risk tolerance, and refine your investment strategy over time. Thirdly, starting early provides a cushion against unexpected financial challenges. Life is full of uncertainties, and having a well-established investment portfolio can provide a safety net during difficult times. By starting early, you give yourself more time to build a robust financial foundation that can withstand unexpected expenses or economic downturns. 11.2.4 Long-term investing strategies. Starting early and investing regularly go hand in hand with adopting a long-term investment approach. Long-term investing focuses on the accumulation of wealth over an extended period, typically 10 years or more. It emphasizes patience, discipline, and a commitment to staying invested through market ups and downs. One of the key benefits of long-term investing is the ability to ride out short-term market volatility. By taking a long-term perspective, you can avoid making impulsive investment decisions based on temporary market fluctuations. Instead, you can focus on the underlying fundamentals of your investments and their potential for long-term growth. Long-term investing also allows you to benefit from the power of compounding. As your investments grow over time, the compounding effect becomes more pronounced. The returns generated by your investments can be reinvested, leading to even greater growth in the future. This compounding effect can significantly accelerate the growth of your wealth over the long term. Another advantage of long-term investing is the ability to take advantage of market cycles. Over time, markets tend to move in cycles of expansion and contraction. By staying invested for the long term, you can capture the upward trends in the market and benefit from the overall growth of the economy. Conclusion. Starting early and investing regularly are two essential strategies for successful investing. By harnessing the power of time and compounding, you can significantly enhance your investment returns and build wealth over the long term. Remember, investing is a marathon, not a sprint. The key is to start early, stay disciplined, and have a long-term perspective. By avoiding the mistake of not starting early and investing regularly, you can set yourself up for a financially secure future. 11.3 Maximizing the power of compounding in your investments. Compounding is a powerful concept in investing that can significantly enhance your wealth over time. It is the process of earning returns on both your initial investment and the accumulated returns from previous periods. By reinvesting your earnings, you can take advantage of the compounding effect and watch your investments grow exponentially. 11.3.1 The magic of compound interest. Compound interest is the key driver behind the power of compounding. It allows your investments to grow at an accelerating rate, as the interest earned in each period is added to the principal amount. Over time, this compounding effect can lead to substantial wealth accumulation. To understand the magic of compound interest, let's consider an example. Suppose you invest $10,000 in a savings account that offers an annual interest rate of 5%. At the end of the first year, you would earn $500 in interest, bringing your total balance to $10,500. In the second year, you would earn interest not only on your initial $10,000 but also on the additional $500. Assuming the interest rate remains the same, you would earn $525 in interest, resulting in a total balance of $11,025. As you can see, the interest earned in each period is added to the principal, allowing your investment to grow at an increasing rate. Over a longer time horizon, the compounding effect becomes even more pronounced, leading to significant wealth accumulation. 11.3.2 The benefits of starting early. One of the most significant advantages of compounding is the ability to start early. The earlier you begin investing, the more time your investments have to grow and benefit from the power of compounding. Let's consider two individuals, John and Sarah. John starts investing $1,000 per year at the age of 25 and continues until he reaches 35, for a total investment of $10,000. Sarah, on the other hand, starts investing the same amount at the age of 35 and continues until she reaches 65, for a total investment of $30,000. Assuming an average annual return of 7%, John's investment would grow to approximately $168,000 by the time he reaches 65. In contrast, Sarah's investment would only grow to around $147,000, despite investing 3 times more than John. This example illustrates the power of starting early. Even though John invested less money overall, the compounding effect allowed his investments to grow significantly due to the longer time horizon. Starting early gives your investments more time to compound, increasing your potential for wealth accumulation. 11.3.3 Strategies to maximize compounding. To maximize the power of compounding in your investments, consider the following strategies. 1. Start investing as early as possible. As discussed earlier, starting early is crucial to take full advantage of compounding. The longer your investments have to grow, the greater the compounding effect. Even if you can only invest a small amount initially, it's better to start early and increase your contributions over time. 2. Be consistent with your investments. Consistency is key when it comes to compounding. Regularly investing a fixed amount, whether it's monthly or annually, allows you to benefit from the compounding effect consistently. Set up automatic contributions to ensure you stay on track and take advantage of compounding over the long term. 3. Reinvest your earnings. To fully harness the power of compounding, reinvest your earnings rather than withdrawing them. By reinvesting dividends, interest, or capital gains, you allow your investments to grow at an accelerated rate. This strategy is particularly effective in long-term investments such as retirement accounts or index funds. 4. Take advantage of tax-advantaged accounts. Tax-advantaged accounts, such as individual retirement accounts (IRAs) or 401k plans, offer significant benefits for compounding. Contributions to these accounts are often tax-deductible or grow tax-free, allowing your investments to compound without the drag of taxes. Take advantage of these accounts to maximize the growth potential of your investments. 5. Diversify your portfolio. Diversification is essential for long-term investment success and can also enhance the power of compounding. By spreading your investments across different asset classes and sectors, you reduce the risk of any single investment negatively impacting your overall portfolio. Diversification helps protect your investments and ensures that compounding can occur across a range of assets. 11.3.4 Long-term investing strategies for wealth accumulation. To fully capitalize on the power of compounding, adopting a long-term investment strategy is crucial. Short-term market fluctuations can disrupt the compounding effect, so it's important to stay focused on your long-term goals. Here are some long-term investing strategies to consider. 1. Invest in index funds or exchange-traded funds, ETFs. Index funds and ETFs are popular investment vehicles that offer broad market exposure. These funds aim to replicate the performance of a specific index, such as the S&P 500. By investing in these funds, you can benefit from the overall growth of the market over the long term, allowing compounding to work its magic. 2. Embrace a buy-and-hold approach. A buy-and-hold strategy involves investing in quality companies or assets and holding them for an extended period, regardless of short-term market fluctuations. This approach allows you to ride out market volatility and benefit from the compounding effect over time. 3. Regularly review and rebalance your portfolio. While a long-term approach is essential, it's still important to periodically review and rebalance your portfolio. As your investments grow, certain assets may become overweighted, increasing your exposure to risk. Rebalancing involves selling some investments and buying others to maintain your desired asset allocation. This strategy ensures that your portfolio remains aligned with your long-term goals. 4. Stay informed and adapt. The investment landscape is constantly evolving, and it's crucial to stay informed and adapt your strategy accordingly. Keep up with market trends, economic indicators, and changes in regulations that may impact your investments. Continual learning and adaptation will help you make informed decisions and maximize the power of compounding. By understanding and harnessing the power of compounding, you can set yourself on a path to long-term wealth accumulation. Start early, be consistent, and adopt a long-term investment strategy that aligns with your goals. With time and patience, the compounding effect can work wonders for your financial future. 11.4 Long-term investing strategies for wealth accumulation. When it comes to investing, one of the most powerful strategies for wealth accumulation is long-term investing. While it may not provide immediate gratification or quick returns, long-term investing has proven to be a reliable and effective approach for building wealth over time. In this section, we will explore the key principles and strategies of long-term investing that can help investors achieve their financial goals. 11.4.1 The power of time in investing. Time is a crucial factor in long-term investing. The longer you stay invested, the more time your investments have to grow and compound. Compound interest is the concept of earning interest on both the initial investment and the accumulated interest over time. This compounding effect can significantly boost your investment returns over the long run. 11.4.2 Setting clear investment goals. Before embarking on a long-term investment strategy, it is essential to set clear investment goals. These goals will serve as a roadmap for your investment journey and help you stay focused and disciplined. Your investment goals should be specific, measurable, achievable, realistic, and time-bound, SMART. By setting SMART goals, you can track your progress and make necessary adjustments along the way. 11.4.3 Diversification for risk management. Diversification is a fundamental principle of long-term investing. By spreading your investments across different asset classes, sectors, and geographic regions, you can reduce the risk of significant losses. Diversification helps to mitigate the impact of market volatility and provides a buffer against the underperformance of individual investments. It is important to regularly review and rebalance your portfolio to maintain an appropriate level of diversification. 11.4.4 Investing in quality companies. When pursuing a long-term investment strategy, it is crucial to focus on investing in quality companies. Quality companies are those with strong fundamentals, a competitive advantage, and a track record of consistent performance. These companies are more likely to withstand market downturns and deliver sustainable growth over the long term. Conduct thorough research and analysis to identify companies with solid financials, a strong management team, and a clear growth strategy. 11.4.5 Dollar cost averaging. Dollar cost averaging is a strategy that involves investing a fixed amount of money at regular intervals, regardless of market conditions. This approach allows investors to buy more shares when prices are low and fewer shares when prices are high. By consistently investing over time, you can take advantage of market fluctuations and potentially lower your average cost per share. Dollar cost averaging helps to remove the emotional element from investing and encourages disciplined investing habits. 11.4.6 Patience and discipline. Patience and discipline are essential virtues for successful long-term investing. It is important to resist the temptation to make impulsive investment decisions based on short-term market fluctuations or the latest investment fads. Stick to your investment plan and avoid trying to time the market. Remember that investing is a long-term journey, and it requires patience to ride out market volatility and stay focused on your goals. 11.4.7 Regular monitoring and review. While long-term investing involves staying invested for an extended period, it is still important to regularly monitor and review your investments. Keep track of the performance of your investments and assess whether they are aligning with your goals. Regularly review your portfolio's asset allocation and make adjustments if necessary. Stay informed about market trends and economic developments that may impact your investments. 11.4.8 Reinvesting dividends and returns. Another strategy for long-term wealth accumulation is reinvesting dividends and returns. Instead of cashing out your investment gains, consider reinvesting them back into your portfolio. Reinvesting dividends and returns allows you to take advantage of the power of compounding and maximize your long-term returns. Over time, the reinvested dividends and returns can significantly contribute to the growth of your investment portfolio. 11.4.9 Seek professional advice. While long-term investing can be a rewarding strategy, it is always beneficial to seek professional advice. Financial advisors and investment professionals can provide valuable insights, guidance, and expertise to help you navigate the complexities of the market. They can assist in developing a personalized investment plan, selecting suitable investment options, and monitoring your progress. Collaborating with professionals can enhance your investment success and provide peace of mind. 11.4.10 Staying informed and continual learning. Lastly, staying informed and continually learning about investing is crucial for long-term success. The investment landscape is constantly evolving, and it is important to stay updated on market trends, economic indicators, and investment strategies. Read books, attend seminars, and follow reputable financial news sources to expand your knowledge and refine your investment approach. Continual learning and adaptation are key to staying ahead in the ever-changing investment landscape. By implementing these long-term investing strategies, investors can position themselves for wealth accumulation over time. Remember, successful long-term investing requires patience, discipline, and a focus on the bigger picture. Stay committed to your investment goals, regularly review and adjust your portfolio, and seek professional advice when needed. With time and the power of compounding, you can build a solid foundation for financial security and achieve your long-term financial goals. 12. Not seeking professional advice. 12.1 The value of professional financial advice. When it comes to investing, seeking professional financial advice can be a game changer. While some investors may feel confident in their ability to navigate the market on their own, the truth is that the complexities of the financial world can be overwhelming. That's where a qualified financial advisor or planner can provide invaluable guidance and expertise. 12.1.1 The expertise and knowledge of professionals. One of the primary benefits of seeking professional financial advice is gaining access to the expertise and knowledge of professionals who have dedicated their careers to understanding the intricacies of the market. Financial advisors and planners have a deep understanding of various investment strategies, financial products, and market trends. They stay up to date with the latest industry news and regulations, allowing them to provide informed recommendations tailored to your specific financial goals and risk tolerance. By working with a professional, you can tap into their wealth of knowledge and experience. They can help you navigate through the complexities of investment options, explain the pros and cons of different strategies, and provide insights into potential risks and rewards. This level of expertise can help you make more informed investment decisions and avoid costly mistakes. 12.1.2 Objective and unbiased advice. Another significant advantage of seeking professional financial advice is the objectivity and unbiased perspective they bring to the table. As investors, we are often influenced by our emotions, biases, and personal beliefs, which can cloud our judgment and lead to irrational investment decisions. A financial advisor, on the other hand, can provide an objective viewpoint and help you make decisions based on facts and analysis rather than emotions. Financial advisors have a fiduciary duty to act in their clients' best interests. This means they are legally obligated to provide advice that is in line with your financial goals and risk tolerance. They are not influenced by commissions or sales targets, which can sometimes lead to conflicts of interest. This objectivity ensures that the advice you receive is unbiased and focused solely on helping you achieve your financial objectives. 12.1.3 Tailored financial planning. A professional financial advisor can help you develop a comprehensive financial plan tailored to your unique circumstances and goals. They will take the time to understand your current financial situation, your short-term and long-term objectives, and your risk tolerance. With this information, they can create a personalized investment strategy that aligns with your needs. Financial advisors can help you set realistic and achievable investment targets, create a diversified portfolio, and develop a disciplined approach to investing. They can also assist with retirement planning, tax optimization, estate planning, and other aspects of your financial life. By working with a professional, you can have peace of mind knowing that your investments are aligned with your goals and that you have a roadmap to achieve financial success. 12.1.4 Monitoring and adjusting your investments. Investing is not a one-time event, it requires ongoing monitoring and adjustments. Market conditions change, economic factors fluctuate, and your personal circumstances may evolve over time. A financial advisor can help you stay on track by regularly reviewing your portfolio, assessing its performance, and making necessary adjustments. Financial advisors have access to sophisticated tools and resources that can help them analyze your investments and identify areas for improvement. They can provide you with regular performance reports, explain the implications of market events, and recommend changes to your investment strategy when needed. This proactive approach ensures that your investments remain aligned with your goals and that you can adapt to changing market conditions. 12.1.5 Peace of mind and confidence. Perhaps one of the most significant benefits of seeking professional financial advice is the peace of mind and confidence it can provide. Investing can be stressful, especially during periods of market volatility or economic uncertainty. Having a trusted advisor by your side can help alleviate anxiety and provide reassurance that you are making sound financial decisions. A financial advisor can act as a sounding board for your investment ideas, answer your questions, and provide guidance during challenging times. They can help you stay focused on your long-term goals and prevent you from making impulsive decisions based on short-term market fluctuations. This peace of mind allows you to approach investing with confidence, knowing that you have a knowledgeable professional supporting you every step of the way. Conclusion. In the world of investing, seeking professional financial advice can be a game changer. The expertise, objectivity, and tailored financial planning that a financial advisor provides can help you make more informed decisions, avoid costly mistakes, and achieve your financial goals. By working with a professional, you can gain peace of mind, confidence, and the reassurance that you have a trusted partner guiding you on your investment journey. So, don't underestimate the value of professional financial advice. It could be the key to your investment success. 12.2 Choosing the right financial advisor. When it comes to investing, seeking professional advice can be a crucial step in avoiding costly mistakes and maximizing your returns. A financial advisor can provide you with valuable insights, guidance, and expertise to help you navigate the complex world of investing. However, not all financial advisors are created equal, and choosing the right one for your needs is essential. In this section, we will discuss the factors to consider when selecting a financial advisor and the steps you can take to ensure you make the best choice. 12.2.1 Understanding your needs and goals. Before you start searching for a financial advisor, it is important to have a clear understanding of your financial needs and goals. Are you looking for help with retirement planning, wealth management, or investment advice? Do you have specific financial goals, such as buying a house or funding your children's education? By identifying your needs and goals, you can narrow down your search and find a financial advisor who specializes in the areas that are most important to you. 12.2.2 Credentials and qualifications. When evaluating potential financial advisors, it is crucial to consider their credentials and qualifications. Look for advisors who hold relevant certifications such as Certified Financial Planner, CFP, Chartered Financial Analyst, CFA, or Certified Investment Management Analyst, CIMA. These certifications demonstrate that the advisor has met rigorous standards of education, experience, and ethics. Additionally, consider the advisor's educational background and professional experience. A strong academic foundation in finance, economics, or a related field can provide a solid knowledge base for advising clients. Similarly, experience working with clients in similar financial situations or industries can be valuable in understanding your unique needs and challenges. 12.2.3 Fee structure and compensation. Financial advisors can be compensated in various ways, including fees, commissions, or a combination of both. It is important to understand how your advisor will be compensated and how it may impact their recommendations. Fee-only advisors charge a transparent fee for their services and do not earn commissions from selling financial products. This fee structure can help ensure that the advisor's recommendations are unbiased and in your best interest. On the other hand, commission-based advisors earn a commission on the financial products they sell. While this compensation structure is not inherently bad, it is important to be aware of potential conflicts of interest. Commission-based advisors may have an incentive to recommend products that offer higher commissions, even if they are not the best fit for your needs. 12.2.4 Fiduciary duty and ethical standards. One of the most critical factors to consider when choosing a financial advisor is their fiduciary duty and ethical standards. A fiduciary is legally obligated to act in their client's best interests and to disclose any potential conflicts of interest. Working with a fiduciary advisor can provide you with peace of mind, knowing that their recommendations are solely based on what is best for you. To determine if an advisor is a fiduciary, ask them directly about their fiduciary duty and whether they are bound by any legal or ethical obligations. Additionally, consider researching any disciplinary actions or complaints against the advisor through regulatory bodies such as the Securities and Exchange Commission (SEC) or the Financial Industry Regulatory Authority (FINRA). 12.2.5 Communication and accessibility. Effective communication is crucial in any client-advisor relationship. When evaluating potential financial advisors, consider their communication style and accessibility. Did they take the time to listen to your concerns and answer your questions? Are they proactive in providing updates and recommendations? A good financial advisor should be able to explain complex financial concepts in a way that you can understand and should be readily available to address your needs and concerns. 12.2.6 Compatibility and trust. Building a strong relationship with your financial advisor is essential for long-term success. Trust and compatibility are key factors to consider when selecting an advisor. You should feel comfortable discussing your financial goals, concerns, and personal circumstances with your advisor. Trust is built over time through open and honest communication, transparency, and a track record of delivering results. To assess compatibility and trust, consider scheduling an initial consultation or interview with potential advisors. Use this opportunity to ask questions, gauge their responsiveness, and assess whether their approach aligns with your values and goals. Trust your instincts and choose an advisor who makes you feel confident and secure in your financial decisions. 12.2.7 References and reviews. Before making a final decision, it is a good idea to seek references and read reviews from current or past clients of the financial advisor. Ask the advisor for references and reach out to these individuals to gain insights into their experience working with the advisor. Additionally, search online for reviews and testimonials from other clients. While reviews should not be the sole basis for your decision, they can provide valuable feedback and help you make an informed choice. 12.2.8 Ongoing monitoring and evaluation. Once you have chosen a financial advisor, it is important to regularly monitor and evaluate their performance. Schedule periodic meetings to review your investment portfolio, assess progress towards your goals, and discuss any changes in your financial situation. Ongoing communication and evaluation will help ensure that your advisor continues to meet your needs and that your investment strategy remains aligned with your goals. In conclusion, choosing the right financial advisor is a crucial step in avoiding investor mistakes and achieving your financial goals. By understanding your needs and goals, evaluating credentials and qualifications, considering the fee structure and compensation, assessing fiduciary duty and ethical standards, and establishing compatibility and trust, you can make an informed decision. Remember to regularly monitor and evaluate your advisor's performance to ensure that they continue to meet your needs over time. 12.3 Working with a financial planner or investment manager. Working with a financial planner or investment manager can be a valuable step in avoiding investor mistakes and achieving your financial goals. These professionals have the knowledge and expertise to guide you through the complexities of the market, help you make informed investment decisions, and provide ongoing support and advice. In this section, we will explore the benefits of working with a financial planner or investment manager and provide guidance on how to find the right professional for your needs. 12.3.1 The role of a financial planner. A financial planner is a professional who helps individuals and families create and implement a comprehensive financial plan. They take into account your financial goals, risk tolerance, and time horizon to develop a personalized strategy that aligns with your needs. A financial planner can assist you in various areas, including retirement planning, tax planning, estate planning, and investment management. One of the key advantages of working with a financial planner is their ability to provide objective advice. They are not influenced by emotions or biases that can often cloud an individual investor's judgment. A financial planner can help you stay focused on your long-term goals and make rational decisions based on your unique circumstances. 12.3.2 The benefits of an investment manager. An investment manager, also known as a portfolio manager, is responsible for managing your investment portfolio on your behalf. They have the expertise to analyze market trends, identify investment opportunities, and make strategic investment decisions. By delegating the day-to-day management of your investments to an investment manager, you can free up your time and energy to focus on other aspects of your life. One of the primary benefits of working with an investment manager is their ability to provide professional investment advice and execute investment strategies. They have access to extensive research and analysis tools, which allows them to make informed investment decisions based on your risk tolerance and investment objectives. An investment manager can also help you diversify your portfolio, manage risk, and optimize your investment returns. 12.3.3 Finding the right financial planner or investment manager. When it comes to finding the right financial planner or investment manager, it is essential to do your due diligence. Here are some key factors to consider. Qualifications and credentials. Look for professionals who hold relevant qualifications and certifications, such as Certified Financial Planner, CFP, or Chartered Financial Analyst, CFA. These designations indicate that the individual has met specific educational and ethical standards. Experience and track record. Consider the professional's experience in the industry and their track record of success. Look for evidence of their ability to generate consistent returns and manage risk effectively. You may also want to ask for references or testimonials from their clients. Fee structure. Understand the fee structure of the financial planner or investment manager. Some professionals charge a flat fee, while others may charge a percentage of the assets under management. Make sure you are comfortable with the fee arrangement and understand any additional costs involved. Communication and accessibility. Effective communication is crucial when working with a financial planner or investment manager. Ensure that the professional is responsive to your inquiries and provides regular updates on your investments. It is also essential to establish clear expectations regarding the frequency and method of communication. Compatibility and trust. Building a strong working relationship with your financial planner or investment manager is essential. Trust and compatibility are key factors in ensuring a successful partnership. Take the time to meet with potential professionals and assess whether you feel comfortable working with them and sharing your financial information. 12.3.4 Collaborating with professionals for investment success. Once you have selected a financial planner or investment manager, it is important to establish clear goals and expectations. Here are some tips for collaborating effectively. Clearly define your goals. Communicate your financial goals and objectives to your financial planner or investment manager. Whether you are saving for retirement, funding your children's education, or building wealth, make sure your professional understands your priorities. Provide relevant information. To help your financial planner or investment manager develop a tailored strategy, provide them with accurate and up-to-date information about your financial situation. This includes details about your income, expenses, assets, liabilities, and any specific investment preferences or constraints. Regularly review your plan. Schedule regular meetings with your financial planner or investment manager to review your investment plan and make any necessary adjustments. Market conditions and personal circumstances can change over time, so it is important to ensure that your strategy remains aligned with your goals. Stay informed. While you have entrusted your financial planner or investment manager with managing your investments, it is still important to stay informed about your portfolio. Ask questions, seek clarification when needed, and educate yourself about basic investment principles. This will enable you to have meaningful discussions with your professional and make informed decisions. Monitor performance. Regularly monitor the performance of your investments and compare them to your goals and expectations. If you have any concerns or questions, discuss them with your financial planner or investment manager. They can provide insights and guidance to help you stay on track. Working with a financial planner or investment manager can provide you with the expertise and support needed to navigate the complexities of the market and avoid common investor mistakes. By finding the right professional and establishing a collaborative relationship, you can enhance your investment success and work towards achieving your financial goals. 12.4 Collaborating with professionals for investment success. Collaborating with professionals can be a crucial step towards achieving investment success. While it is possible to navigate the investment landscape on your own, seeking the guidance and expertise of professionals can provide you with valuable insights, reduce risks, and help you make informed decisions. In this section, we will explore the benefits of collaborating with professionals and how to effectively work with them to enhance your investment journey. 12.4.1 The role of professionals in investment. Financial professionals, such as financial advisors, investment managers, and wealth managers, have extensive knowledge and experience in the field of investing. They can offer valuable advice, conduct thorough research, and provide personalized strategies tailored to your financial goals and risk tolerance. By collaborating with professionals, you can tap into their expertise and benefit from their insights, which can help you navigate the complexities of the market more effectively. 12.4.2 Identifying your needs. Before seeking professional advice, it is essential to identify your specific investment needs and goals. Take the time to reflect on your financial objectives, risk tolerance, and time horizon. Are you looking to grow your wealth over the long term, or do you have short-term financial goals? Are you comfortable with higher risk investments, or do you prefer a more conservative approach? Understanding your needs will help you find the right professional who aligns with your investment objectives. 12.4.3 Choosing the right professional. When selecting a professional to collaborate with, it is crucial to conduct thorough research and due diligence. Consider their qualifications, experience, and track record. Look for professionals who are registered with reputable regulatory bodies and have a solid reputation in the industry. Additionally, seek recommendations from trusted sources, such as friends, family, or colleagues who have had positive experiences with professionals in the field. 12.4.4 Working with a financial advisor. A financial advisor can be a valuable resource in helping you make informed investment decisions. They can provide personalized advice, create a comprehensive financial plan, and guide you through various investment options. When working with a financial advisor, it is essential to establish clear communication and maintain an open dialogue. Be transparent about your financial goals, risk tolerance, and any concerns you may have. This will enable your advisor to tailor their recommendations to your specific needs. 12.4.5 Collaborating with an investment manager. If you prefer a more hands-off approach to investing, collaborating with an investment manager may be the right choice for you. An investment manager will actively manage your portfolio, making investment decisions on your behalf. They will conduct thorough research, monitor market trends, and adjust your portfolio as needed. When working with an investment manager, it is crucial to establish clear expectations and regularly review your investment performance. This will ensure that your portfolio remains aligned with your financial goals. 12.4.6 Regular communication and review. Collaborating with professionals requires ongoing communication and regular review of your investment strategy. Schedule periodic meetings with your financial advisor or investment manager to discuss any changes in your financial situation, investment goals, or risk tolerance. These meetings provide an opportunity to assess the performance of your investments, make any necessary adjustments, and ensure that your investment strategy remains aligned with your long-term objectives. 12.4.7 Evaluating performance and fees. When collaborating with professionals, it is essential to evaluate the performance of your investments and the fees associated with their services. Regularly review your investment performance against relevant benchmarks and assess whether your investments are meeting your expectations. Additionally, understand the fees and charges associated with the services provided by professionals. Ensure that the fees are reasonable and transparent, and that they align with the value you receive from their expertise. 12.4.8 Continual learning and adaptation. While collaborating with professionals can provide valuable guidance, it is important to continue learning and stay informed about the investment landscape. Take the time to educate yourself about different investment strategies, market trends, and economic factors that may impact your investments. This will enable you to have more meaningful discussions with professionals and make informed decisions about your investment portfolio. 12.4.9 Building a long-term relationship. Building a long-term relationship with professionals can be beneficial for your investment journey. As you work together over time, professionals will gain a deeper understanding of your financial goals, risk tolerance, and investment preferences. This knowledge allows them to provide more personalized advice and adapt your investment strategy as needed. By maintaining a long-term relationship, you can leverage their expertise and experience to navigate the ever-changing investment landscape more effectively. In conclusion, collaborating with professionals can significantly enhance your investment success. By seeking the guidance of financial advisors, investment managers, or wealth managers, you can tap into their expertise, benefit from personalized strategies, and make informed investment decisions. Remember to identify your specific investment needs, choose the right professional, maintain open communication, regularly review your investment strategy, and continue learning about the investment landscape. By doing so, you can build a strong foundation for long-term investment success.